It's 7 o'clock. Good evening, everyone. I have tried to call in as many people as possible. Today, I am using an iOS device which I gifted to my daughter still to buy one to use because I am very uncomfortable with an iOS. So I got one, I gave it to her. She uses it. If I'm able to get it from her, I conduct the spaces on it. But maybe I'll get one for this purpose standalone. But having said that, since I'm using that, there should be no glitches. Usually, there are none when we work with a iPhone. What I'll do is I'll try to bring in, I'll try to first round up what we discussed last week, the last two times that I did this space, which is titled "Who Let the Bears Out." So it's been the third time we are actually giving the same title because the discussion has been around some common topics. In terms of the September one was around what happens if rates continue to rise and their impact on fixed deposits and the fight for liquidity. Fortunate to have had Deepak Shenoy and Ritesh both at that time. Ritesh jumped in last time also to discuss the liquidity issue, which was overhanging so much. So I think that gave me greater conviction in the report that I wrote. So for those who don't know, I write the long short report, which is a strategy note every 1 to 3 months to sort of put together where I think markets are, especially when there's an important juncture, sentiment, data, macro all comes together, and then that sort of sets the tone of how I'm thinking. And so it really helped me to do that Friday Spaces. The inputs that I got from Ritesh, I felt that the time is appropriate. Though, if you heard the Weekend with India charts, I was actually telling Shivam that he told me, why don't you, isn't it time to write it if you're feeling so sure? And I was like, yeah, I'm just scared that uh, I've been waiting to write. I've been written one for 3 months. I was away in between, and then I don't want to go wrong. And so that is human nature. Some people may not realize it, may think we always want to be right. And so that behavioral aspects affects all of us. And so with that reasoning, and then I went back to my own behavioral finance post under the educate yourself section. I'd written a post which says trade against your own thoughts and feelings. And so that struck me, and I said basically what I was saying by telling him that, oh, I'm scared of being wrong here, is this is the right time actually. So you're supposed to go against. If you feel greedy, or you feel fearful, actually greed doesn't hardly comes to people who are sane. It's usually fear of missing out or fear of losing out. So fear of losing out, usually at bottoms you're scared to buy, which is means it's the right time to buy. And similarly, if you're feeling the fear of missing out, then you have the other extreme. And so here I'm scared of going wrong. So probably it was the right thing to do. And so I thought so. We just had the events of this week coming in. And so I ended up writing the report on Monday. I really urge everyone to read it if you haven't, because 37 charts put together that really highlight what my broad view is. And once I go over that, I'll just put together everything I've heard and thought. If as people join in, then I'll ask some of the speakers to also add their points, and then I'll get into Q&A and add other people who are which I can already see many here who I know. So just give me a moment before I add others to speak. I just want to get my points across before it becomes a discussion which everybody's jumping in with their ideas. So we'll have more discussion. Like I said, iOS, I hope it works, and if it works, then I should be able to add join requests and get more interaction than we did last time. Last time it was more of us talking, and by the time we got to the interactions, the spaces was hanging up. So I'm hoping that will not happen today. So just give me a moment, everyone. I can see Sharad and Amol, Trendonomics, whoever wants to speak. If I get requests, I will add later as we go along. Just let me first start off this discussion on the market side. And be rest assured, clear. Even if somebody has an opinion which is opposing, somebody wants to share a bull bear view. I've always been completely okay with both opinions. Only these vague people who want to just get into arguments or point fingers or have some other intentions. If we sense that, that's where it will be upsetting. So then we'll take corrective action if required. But otherwise, every discussion should be on both sides of the table so that we can get the best of thoughts, ideas, and get out of what should we be really thinking? How should we strategize? Those things get only clarified when you have different opinions on the table and you have a fair discussion with an open mind. So that is how it is. And so even on Twitter, if somebody comes in and trolls nowadays, the first thing, if it gets personal, I say, okay, you haven't met me, so how are you really taking a view on what I am like, or what I'm really thinking, because you don't know me as a person. But the funny thing is, the last time I did that, this person started messaging me on the phone number I shared, to buy his advisory service for 1 lakh rupees. Now that is the most stupid thing that could have happened. Here I was trying to stretch a hand, and he was trying to sell me something, and so I said, forget it. Then I don't want to meet you. And he left by giving me, 4-letter words and then quitting, and then blocking. So that is like as weird as it gets from people who have no soul. Actually, there's soulless people out there. You need to be really careful of trolls who are advisors. I've come to know that trolls who are advisors trying to get attention and followers by trolling other people, the most stupid strategy. It should be obvious to any sane person that this is what these guys are doing. The first thing you should check is their profiles and get an idea of who's trolling. I mean, who's any good. If anybody is any good at what he's doing, I'm sure he has absolutely no time to troll anybody else. So anyway, it's a waste of time, but I enjoy getting into discussions with all trolls. As you have seen, many people tell me why you're wasting your time. Maybe I'll help somebody is how I think about it. So anyway, coming back to the market, it's been very interesting. Days waiting for things to fall in place, and I think at least the way it looks, and we'll get more confirmations from time frame to time frame. We have the daily charts breaking down as of today. The bank nifty walking away from what may be the end of a big move. We want to now see those things confirm on higher time frames, which means we'll move to the weekly time frame. And the best part is monthly time frames never change. So the monthly momentum cycles measured by the Rohit momentum indicator remain in sell mode. And light of that, then we look at what the weekly and daily are really doing and what the sentiment is really doing. That has been my broad and general approach. I see Rajat ji also. I'll try to bring him in to speak if he's hopefully stay around. Just let me complete my talk, then I'll add people who I know can add value here, and then we'll get a discussion going. So Rajat ji, just hang around. And so here, let me sum it up. I've written this very detailed report, which tries to look at various alternate scenarios for the Indian market. But if I have to put it in one line, I think since October of last year, I didn't initially think we would go into a bear market. I thought there was strength in individual stocks and sectors that would hold up, which is sort of how the market has been on a 12-month basis. But given April, when the dollar really started to break out, I thought it was time to give in to the macro trends. Usually, it's good to ignore macro stuff up to a point because it doesn't always correlate with the market. So even if the dollar was rising all of 2021, I was sort of still bullish on the market, irrespective, because it didn't matter. Even the commodity cycle was still holding up well in the face of the dollar, and I thought the dollar is in a long-term bear market. Now, crossing 90 or 100, I think somewhere in the 90s is where we were in April, is where it had gone beyond all the retracements and the monthly signals were crossing over to the buy side. It meant that something is changing. Now the question is that change permanent or temporary? Well, it remained for quite some time. The last 2 months has given everybody an opportunity to turn tables, because the dollar index has fallen back from what 115, 16 all the way back to 103, 104. Now remember, 103, 104 is where we topped in 2017 for the first time, and then we topped there again in 2020. So when we went past that level, we actually breaking out of a 5-6 year trading range. Just to think that because it's fallen back to 103 and 4, we're saying it's a big reversal in the dollar. And I think that could be completely wrong, because anyone who knows, understands the process of how prices move, they sometimes pull back to the breakout point, take support there, and then move again. So to call this a false breakout, you really need to have a wave structure which supports it. Right now, even if I look at the monthly momentum, what it's really done is, on the dollar index, it's pulled all the way back to zero, and actually given a fresh buy signal, which is still holding strong. So right now I will only look at this pullback to 104 as a pullback after a long-term breakout, and the larger trend to the upside should actually resume. So this is the first thing to highlight, which is on the dollar. Now, the next thing that I will really want to add is on the bond market. So these are the two big things. I think end of day, after studying everything, putting together all the points specific to the Indian market, the two big things I think which are also macro, which we really should think about, reflecting upon is one, what the bond market is doing, and two, what the dollar is doing, and then put it in the Indian context, right? Why only talk about the U.S. bond market and the U.S. dollar? We look at the USD INR and then we look at the 10-year GSEC in India. What are they really telling us in terms of the picture that is really developing? So when I look at that picture, I think the USD INR has shown far greater strength, and that is where I think ignorance is bliss, because we slowly developed a current account deficit problem, which is now glaring. It's staring in the face. I don't know if anybody can argue that this is not a problem and it's going to go away tomorrow morning. Especially given that even people who accept that yes, worldwide we have a problem, but India doesn't have a problem. Fine, India is great, and but what do we do about the currency? Because finally, if the world is going to face a problem, and let's say nothing else changes, one thing which will be affected is going to be your external sector. And if the external sector is affected, it's going to affect both flows and exports both, which means your CAD problem will only go from what is already bad to worse. And so there's no way I can see what the currency charts are showing us, because even in this big decline in the DXY, the USDNR has actually taken support on the 20-week average and shot up. Okay, so it's already started an upward trend. It's resumed its upward trend, we should say. It never broke down. Unlike many other currencies of the developed markets which have broken down, or even some of the EM currencies that may have consolidated, the USD INR remains in a very, very firm and strong upward trend. So this is an important part. And so if you are in a environment where the currency is going to weaken far more, should can we really be ignorant of it? Can we have an environment where the currency also weakens and the equity market also continues to go up? The only places we have seen that happen has been in hyperinflations. Okay, so wherever there's a hyperinflationary market, we have seen that kind of market behavior, but not in other places. Okay, so I don't think we are in a hyperinflationary scenario. Okay, so where you get both equities and it's like what happened in Venezuela or what happened in uh, Zimbabwe. These were places where we've seen that. So that's not really the scene that we are expecting. But what we are seeing, therefore, is uh, an adjustment, because our currency is far stronger than many others. And what happens in this kind of an adjustment is, I think the most direct impact is going to be bond yields. And in fact, I was plotting a chart of both the DXY and bond, I mean USD-INR and the 10-year GSEC together, just to see whether the correlation is changing. See, typically yields are down, we say currency is being weakened by keeping yields down, and you raise yields basically to strengthen your currency. And that relationship can show up if you look at a 5, 6, 7 year chart. You'll see periods where it looks like the two are inverted with a lead lag. But if we just look at the last couple of months, I'm actually seeing the buildup of a positive relationship, which means bond yields have been rising and the USD-INR has been rising. Okay. And bond yields, of course, have paused between 7.2 and 7.5% for the last several months. Looks like a consolidation to me. And if it is a consolidation, then I think with the USD-INR again starting to move up to break out, it's going to take yields with it. That is my sense. And if you break out of this range, because the 10-year GSEC is in a falling channel all the way from 2014, the breakout point is somewhere around 7.2%. So we are trading mildly above it. And the 1 year consolidation, like I said, between 6.7 or 7.2 and 7.5, if we break above 7.5, then we are out of this entire pattern, congestion of 1 year and the 6 year falling channel, which then sets us up to go and retest the previous highs, which has been slightly above the 9% mark. Now, if you tell anybody that 10-year GSEC goes to 9%, he'll say you're completely crazy and you should leave the room. But that's always how psychology is. What will cause that to happen? These are just charts. What will cause that to happen is unknown. But what I do know is that in every final case of crisis, so if I actually study the long wave, which is you go and look at any super cycle degree bear market, it's always been associated with a bond market spike, and that is after yields have gone down significantly. So you have this big decline in yields between what we call the economic summer and the economic autumn. Okay, so the summer is the flattening period in India. That was in the 1990s. In US, it was the 1970s, where you have high inflation, high interest rates, and then from there rates start coming down, 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 and then they find a much lower level. The last stage is where you get an interest rate spike, which really causes the last bear market of what is known as the economic winter. And that's something that I thought maybe would have happened in 2018-19, because I was anticipating this yield spike back then, and then it didn't happen. We just went to 8% or 7.57%, and then after that, after the ILFS bailout, the yield started to go down. If that was true, then yields shouldn't have come back right now to the same level. They should have continued to remain in a bear market, and that should have been supportive of a economic spring. The whole reason that yields are breaking out means that we are risking going back into an economic winter for India, which is a final yield spike, which nobody is really anticipating, coming on the back of a weaker currency. And all of that playing out means you get one last selling climax uh, in the equity space, which is visible. I think the leading market which is weakening, showing that, has been the US, right? Because US has been the only one which has been thumping the table that we need to raise rates and need to make this adjustment. Everyone else has been backing off from doing it because nobody wants to deal with the problems that come. But as you know, Bank of England just raised interest rates around half an hour or an hour back by 50 basis points. And just few days ago, I had posted a chart of bond yields across Europe, all breaking out of wedges, basically showing that yields have to go up in Europe because inflation there is even higher. Sure, you may have had peak inflation. Maybe inflation is coming off in a couple of places. But even then, at 10%, even after coming off, it's very, very high in Europe. So you can't really be at 3% interest rate and 10% bond yields. So that is a very, very big gap, I think, that is not fixed. And then if you look at the the spread between the Indian yield and the US yield, or the, in older times it used to be the LIBOR. People used to look at the LIBOR and LIBOR spread just to figure out whether Indian corporates can even borrow at this rate or not. And there's typically a premium that you have to pay for forex risk. Now we have the lowest spread, the lowest differential historically right now between these yields, and that doesn't just add in. So that's another adjustment that has to happen. Our yields are far, far lower compared to other markets which are adjusting on the way up. So in a sense, we are in a rising interest rate environment, a tightening liquidity environment around the world. Unless something changes that, unless we go back to QE in a more serious way, not just the temporary adjustment through the treasury general account that we discussed in the last spaces, which may be behind us for now. Surely they can do those things again. They can always come in with reverse repos. India can go for swaps and all of that. But unless we are at that point to really try and say that, oh, this is what is going to happen, might not be the right approach, because we may end up misleading ourselves in believing that, well, everything that the Fed is saying is just a hoax, and we should probably not listen to what they are saying. And they're thumping the table since August that this is what they want to do. They want to keep rates higher for longer because they want to see the inflation animal really be put to place. They don't want it to come back. Okay, moment we stop hiking, oil goes back up, commodities rise, and we have inflation all over again. So that's not a situation they want. They've already been through that in the 70s. So if they're using that as the model to really go through with this, then most probably they're going to do something different, which is what he's saying, that we're going to keep it high. And as per yesterday's Fed meeting, going to keep it high all of 2023. So whether that high is 4.75 or it's 5, of course, the terminal rate right now is appearing to be nearer to 5.1%. Plus or minus of that, if rates are going to stay there, one thing is clear: the US will go through a significant slowdown, if not in the economy, at least in earnings. That is already getting set in course. So if you're looking at weaker earnings, you're looking at a weaker economy, the risk of a recession, all that is really not meaningfully priced in. Bond yields are still rising, so they're not reached the point where they recognize that yes, there's a recession and yields will be cut, and so the bond market starts a rally. We are not even there yet. That's usually how the cycle really pans out. So right now, where we are is we are at the, I think, at the edge of risk, in India specifically, because India has been rallying away saying kuch farak nahi padta hai, and I don't believe in the decoupling argument completely. And I think the biggest risks to our market, basically, which is what I want to focus on in this discussion, is the weakness that will be driven by the currency market into the bond market, which means that if you are dealing with higher yields here, you cross 7.5%, the current valuations that the market has, even all else remains equal, will not be justifiable. So you get a valuation correction. So that's number one, because and that's what started the US sell-off, right? It hasn't been through a earnings recession yet, even though earnings are flattening out this quarter. But what they've been through is a valuation correction, essentially on the back of rising interest rates, and that's something that India has not been through. And I think the risk is essentially there if yields spike further from here, which I think they will. So that is my broad take, and I think we are sitting right on top of it. Most of the so this rally has been stretching since the bottom in October. The way I have taken this market is take it trade to trade. Look at the trade setup. If it's an up-down market, which is what I said from April when we were at 18,200, that let me start treating this as an up-down market, because it had been going up and down since October, and I was not recognizing that. I was still treating it as a bull market. In an up-down market, you get oversold, you buy, you get overbought, you sell, and you keep going up 1,000 points, 2,000 points, you sell off 1,000, 2,000 points. I think that is not over, and unless we are through with this, the macro risk part, I think we might not be done with that type of market, which we are really going through right now. So in that, then you simply look at sentiment extremes. So whether it was at the start of October, where I cited that we had a huge short positioning as far as institutional investors were concerned, which was a reason for the rally. The rallies, of course, stretched longer than I thought. I didn't think it'll go past 18,300. We've gone to 18,900, no problem. But in the process of getting to 18,900, we've gone to the other end of the spectrum, which is that we have the highest long position. In fact, second highest long position for FIs. We have the highest ever premium. This was the shocker of them all. The premium that we saw in index futures for December has never been elevated for this longer period. I mean, 1 week or 2 weeks into post expiry are still at 70, 80 points today. It's never happened. It usually dies off by the first week itself. Usually it 70, 80 points was the previous all-time high, and then it quickly goes back to 50, 40, 30. Here it has been elevated over 100 points till 2 days ago, and just today I think I'm seeing it at less than 100, and which is still high at 80 points. This elevation means something, whether you like it or not. To me, it simply means an over bullish market. So anybody who tells me that, oh, everybody's bearish market can't go down, is simply talking about the 4 friends he knows, or probably he's an India Charts follower, and he only knows India Charts subscribers, and therefore he thinks that everybody's bearish. The world doesn't flow like that. I look at positioning. If FI has had the second largest long position in index futures since 2019, it means that everybody is long. If people are willing to pay an 80, 100, 120, 140 points premium current month, and look at January futures premium, which is well over 200 points, willingness to pay that much for a position to hold on, which is a record, simply means people are over bullish. So that is how I read. I read market data. I don't read my Twitter account to figure out if everybody is bullish or bearish. Of course, there are lots of software out there that are trying to read Twitter RT and then trade otherwise, which causes these big crazy spikes, as we saw in the US market, where CPI data leads to a 500-point move and then everything gives up. That's all machine learning at work. But when it comes to analysis, which we can do as human beings and still remain sane, you simply look at the data. What is the positioning? The data is available. The positioning says that everybody is bullish, and if everybody is bullish and this is a trading market, it's time not to be on that side of the bet, right? So I'm not going to be bullish. In fact, I'm still calling this a bear market rally. I'm completely out of any investing right here. So it's a stated fact already on my weekend shows that I've taken the wild decision to be 100% cash, which I can do because I'm an individual investor. We don't give advice to anybody, so we do nothing which should be regulatory, right? So no advisory service, no PMS, no asset management, no research calls, no buy sell recommendations, no stop loss, nothing. So that leaves people at loss. ये बोल क्या रहा है, करना क्या चाहिए इसको? But that gives me the freedom. That gives me the freedom to do and say exactly what I want to do, and to ignore any kind of debate or discussion on this subject, because why should there be a debate? You know, I don't have to prove that I was right for the last 4% in the market by outperforming it. That's not my task. I need to know what happens next, and the science to do that is available. The science is to combine everything, to combine technicals, economics, fundamentals, and it can all be combined if you're willing to open your eyes and do it. Since it doesn't make sense to everybody, sales forecasts are often made by putting together data points the way that it's best suits to where investors can understand, and so therefore everything is fine tuned in a way that people can understand it. I'm often pushed to do that, make your writing more simple, sound less technical. लोगों को समझ में नहीं आ रहा है आप क्या बोलते हो. We try very hard, but at the end of the day, the question is twofold. Are you going to elevate your knowledge level and understanding of markets to a higher point than where you are, or are you going to tell me to downgrade the way I think about things? So I really urge people to upgrade rather than ask me to downgrade my thinking and my way of putting it across. Of course, we can try and be more objective, but this is how I've been trained to think and do, and so that is where I'm positioned. So yes, I think this is a bear market rally. I think it's over. The short-term setups have all turned bearish in the last 2 days. I think banking was the last one we were waiting for, and it's achieved the last ABC or Z, as Jay has been pointing out. And today's negative close, we'll usually say that the recent high that the Bank Nifty made yesterday should be the peak, and unless that is surpassed, we would think that the trend down has started. The next level would be to really move to the weekly level. So tomorrow we're going to be watching whether the weekly RMI or the weekly momentum gives a sell or not. So we go level by level for confirmation. So there are two things that people always want to understand. There's a view and there's an execution, right? So when I say this is my view, people say, okay, how do I trade this? Now execution is basically position sizing with a handful of indicators. So we're using all of these. I use my RMI. We look at averages. We look at the recent swing highs and lows, and based on that, I can build a position and I can execute. So that's a completely different task. And so we are looking at weekly confirmations, daily confirmations, and so on. We have a monthly sell which is anyway running on the RMI indicator. So we're looking at whether lower time frames confirm with that, and then we have a setup to go with. But that doesn't really change the view. I mean, just because the weekly is not confirmed, that doesn't mean that I'll not say that this is, because the right time to really say something or do something is when the risk reward is favorable, not when it becomes unfavorable. So we can't come here and say after a 20% fall in the market, ki, yes, now it is confirmed a bear market. If I had to do that, then I wouldn't be doing the job that I'm doing, nor would my teams be trained to do the same. And so I think we work at the highest level, being able to judge what's going to happen and act accordingly. And being an early investor also gives you that advantage. So people who come in at 15,000 or who have only invested after 12,000 probably don't want to get out at 18,000, and so therefore they'll argue a very different tune with you and try to tell you, why you could be wrong. On the other hand, I argue back saying, well, I am invested for the last 3 years. Why shouldn't I protect my gains? I mean, this is my job. It's my money. Why do I care about riding the next 500 points without being judgmental about whether there's any risk in doing that? And on the other hand, there may be trades to the opposite side of the market that I might be able to take. So this is only possible if you're independent. It is not possible if you have other pressure points. And I somewhere don't have the luck of managing other people's money also. So I think whenever I try to do that, they make sure that I fail by changing the rules. And so one thing I don't want to do is to change the rules with which I operate. So this is my take. I've broadly put it together. I've explained my positioning, my view. I have not put any level to it, but clearly, if I'm saying this is a bear market, the downside is open. And when I say open, it's open to all levels. I mean, you could give me any level. You could ask me, are you going to go back to 15,200? I'll say, why not? Can we go below that? Why not? Can we stop above that at 17,000? Maybe. We can always judge when we get to 17,000 whether we'll hold there or not. The point is, the risk is open, and what are you going to do about it? And so that is the real thing. Getting into arguments about if I could say the risk is limited, which is how I started out 2022, then I probably wouldn't be saying everything I'm saying. So I started out the year by thinking risk is limited, so I'll hold on to my portfolio and only manage the up and down side, and not sell anything that is holding on to the weekly trends. But after April, I took a very different view. Many times I went back to being 60-70% cash and so on. But right now I've taken a call that I might as well just stay away 100%. So So that's it. I think what I'll do is bring in other opinions, and then we can have Q and A. People can put in Q and A requests as well. I have with me. Let me see. Uh, so I'm going to actually accept the requests. Sarvendra, I've been talking for a while. If you want to add something, you can take it.
Yeah, very good evening and thank you. See, I was listening to all your weekly setups, and I think Friday is where.
Just one thing, I'm just trying to invite Rajit. If you are willing to join, I've been sending you an invite. You can join in and add your words of wisdom. Yeah, Sarvendra.
Yeah, so being so Friday definitely will get you the closest for everything else. But I think for me, I look at the Friday chart also, but I also look at the what do you call Valan to Valan chart. So I think Valan is Thursday. Every Thursday is a Valan for Nifty Bank Nifty. So those charts are already. If you look at a Thursday chart, expiry to expiry chart, then you'll see that your week starts on Friday. Okay, and today the week has already closed for me on my chart. So I had pointed out that last week also that Nifty had an inside weekly bar, which is a fairly good pattern. And then this entire week now, that this current week that ended today on Thursday, expiry for me has been a follow through of that inside bar. So the entire candle, if you can, people who follow candles can go and check that weekly entire candle is below the candle of the last of the inside of the inside bar itself. So now we have a fairly bearish setup going in, and these patterns have got a bad habit and a high probability of giving you reversals, big ones. So I think, yeah, I would agree with you, Concur, that my weekly setups are also telling me that we are already gone. Nifty, the momentum, weekly momentum is already gone with this week's candle. Bank Nifty has just started, so yeah, we are rolling on the momentum side of the Bank Nifty. But Bank Nifty candle also is a fairly bearish candle to me. It's a small bar, but it's a fairly red close is what I wanted on the weekly expiry closes, and Bank Nifty has given that. So the confirmation has come, as you rightly pointed out, and so as long as all these setups are there and there's nothing to prove otherwise, I would continue to believe that these two indices have topped out, and gradually everything else will probably follow. So I think for these two indices, these I would agree and kind of advance warn that it's already for the Friday close. Bad.
Great. Rajitji, you want to add comments? I've spoken for quite a while. I really like to have your views. And if you do have views on the currency and the bond.
Good evening, Rohit, and good evening to all of those who are in this space today. Uh, First of all, I have a request, Rohit. Can we take out the G after the first name? It is better if we interpolate each other with uh,
Surely.
Rohit and
No, but
Rajat. Or
instead of G, will say Rajat Da. Okay.
Rajat, everything. I mean, both will do. First of all, I would like to express my admiration. It is not that Rohit has invited me, and that's why I'm admiring what he had to say uh, right now. I mean, a little earlier. Uh, that is, I'm completely in agreement with him. I would add certain data points and I would also say, although I'm not 100% cash, but I would like to add certain data points here, is that I foresee a very problematic, not just 2023, going forward, things would not be as rosy. I mean, we had a one way traffic almost, except for the year. In 2020, there had been problems due to COVID, and prior to that, in 2016, there had been 11th or 12-month long, very steady kind of a fall that happened. But otherwise, we have seen a bull market that is primarily driven by humongous liquidity. First, between 2014 and 2019, there had been $16 trillion that had been added. And after that, uh, between April 2020 and October 2021, another $9 trillion. The balance sheets of all the central banks actually bulged like anything. The Fed still has $7 trillion worth of securities in its portfolio. But what I would like to point out, what I would like to point out here is this: that uh, the interest rate cycle, 1945 post-war scenario, it was U.S. interest rates were at two or between two and two and a half. That was the bottom. From there, it started rising, and it was the year 1980, 1981, around that time when Paul Volcker, in order to contain inflation, raised the interest rates. Long-term interest rates went up to 16% in the US, and short-term interest rates went up to 20%. From there, from there, what what began was from there what began was a one-way downside in the interest rates, which recently bottomed out in Europe. The anathema also happened, that is the negative interest rates, uh, which is, to my mind, is an absurdity. And the other thing is that also during this period, a particular kind of economic ideology also flourished, that is neoliberalism. And uh, I mean, certain section of people, uh, they made a lot of money. I have nothing against that. We are not getting into any kind of political argument here. Only thing is that uh, Rohit talked about 1970s. 1970s, I would say, if you look at what happened, the US Fed at that point of time between 1922 and 1928, even though the American economy, US economy was firing on all cylinders, it artificially depressed the rates. And what people define or economists define as financial repression, that has been happening around that time. That the inflation rate was higher than the Treasury bond yield. And actually, this kind of things are done to take away dates of the balance sheets of from the balance sheets of the governments. Post-war, uh, Britain as well as France took the same route. You know that in India, the inflation rate for all of us, I mean, whatever the CPI might say, actually, it is the inflation is higher. We are going through a financial repression. These things make a setup, and artificial lowering of interest rates in this manner, where it has happened, it has actually caused a lot of turmoil. Once you are unable, just as Rohit said, that they might they just might have to, if they pause here, if they pause or cut rates at any point in time, inflation will rear its ugly head again. It is not possible to just contain inflation this time. This time the genie is already out of the bottle. So the point here is that given that kind of a scenario, uh, I feel, and I have also checked. I've checked charts in Europe, charts U.S. market, especially the yearly charts. If you look at the yearly charts, you test anything. Microsoft, you check Apple, you check Google, whatever, and also you check the Adani stocks. You will find they are just like a skyscraper. I mean, last 2 years or so. In some cases, I mean, Adani is a prime example of that. Adani Enterprise or something. So this kind of I checked. I went back. I saw how the charts had been abroad or in India. Whenever the yearly chart shoots up like this, we actually go through not just a 1 year correction, it has to be a several year correction. So my point is that I am completely in agreement. Although I'm a research analyst, I have some clients. I do not take any new clients. But my point is that even if the regulator holds me up, that why are you giving this kind of a projection or something, I would show that yes, this is what the data suggests. And another thing is that recently, another very, very telling sign. A lot of Indians, lot of over enthusiastic Indians who are participating in the stock market, also the pink newspapers started celebrating. Look, we have decoupled. This decoupling is actually bogus. It is rubbish, I would say. I'm using strong words, yes, very knowingly, very candidly. I'm doing it. The reason behind that, this is typically the situation where, when this decoupling kind of a thing, the mirage kind of a decoupling that happens, George Soros calls it the super bubble. Super bubble in that country. It has happened for China and now it is happening for India. And the super bubble kind of thing is that you are not, you are not living in a vacuum. You are saying that the interest rate differentials between US and India doesn't matter, and the carry trade that was there now not happening out here, it is happening for elsewhere. These things don't happen. Just study interest rate history. You will find that things are actually not that rosy. In fact, it is suggesting that there could be a multi-year corrective phase. I'm not using the word, using the phrase bear market. I know that in the current environment is not. I mean, I would have to provide, say, some kind of a digestive tablets or something to gulp that bear market phrase. So I'm saying a multi-year corrective phase. It isn't as if there would not be bear market rallies. There would be rallies, there would be sharp rallies that happens in bear markets, but a generation, right from the year 2000 till about 2022, a generation has been raised who believes that any fall is worth buying, but valuation doesn't matter, overvaluation doesn't matter. You just buy to wait. If it falls, it will go up. It'll go up. There are phases in the history of stock markets around the world when you have to wait for sometimes 15 years, sometimes 10 years, sometimes even more to get to the level that you rise. So all those parameters will make a comeback. I'm sorry, boss. I'm unable to give any palliatives out here. I see a major problem. I see a major problem. Only my suggestion, it is not my advice, not my request or anything. Only my suggestion is that any company that actually posts an return on capital below 15%, and there may be lots of covers around those companies, please, for God's sake, do not be invested in those companies, because they are going to. I've tasted. I've gone back and I've tasted that these are the stocks that suffer. I mean, the sound of an ambulance could perhaps be prophetic at the moment.
Rajat, I think I also tweeted the fact that if 2023 does 15%, 8 plus 8, why should I be in equities? So I would agree with you that the risks are too much, and all those companies which are
Rajat, can you
on their RPE, then they need to be avoided for the whole.
Satendra, you're cracking a lot, or if it's the network or what your voice is cracking, just check on that.
No, I think Rajat Das
Okay.
mic was on, so I think it was equal. What I was saying, that I also tweeted the same thing, that if 2023 does not make me 8 plus 8, 8 is the risk free, and plus if I don't make 8% more on the while taking risk, if I don't make 15-16% in a year in 2023, there's no way that you would be wanting to take that journey. And secondly, as he rightly pointed out, I also was talking to someone yesterday, to a client, and I told him that, boss, a basic filter is that any company which is not doing an ROC of more than 15-16% or a return on equity of more than 15-16% will not be able to make you money in 2023. Basic plain vanilla maths, nothing rocket science here. So you should be avoiding all those names, and yes, all those names can get seriously punished going forward.
I'll just raise a question, Rajat, and you can answer that, because you mentioned. So why, if you can just explain for people who are more novice, that why 15%? Why that number? Does it relate with the rates? Does it relate with what is it exactly drives that logic?
Well, Rohit, if you if you think, if you say the risk-free rate of return at the moment is about 7.5%, I am talking about 10-year tenor. Add to that, an equity risk premium. In our markets, equity risk premium is simply not there, but it actually rears its ugly head and in bad times, and that is the reason why it has been found that even if you are in a commoditized business, you actually should be generating a return on capital. Return on capital that is, say, something like risk-free rate of return plus a good, if it is an emerging market, at least 5 to 7% you add for equity risk premium. And that's why it comes to about, say, roughly say 14 and a half. And so that's why I said 15. Very frankly, uh, uh, I I'm I'm currently holding 4 stocks, and all of them have return on capital above say 30-35%, because these stocks are generally stocks with good moats and they tend to bounce back. Although I really appreciate your 100% cash, because I wish I also could take that, but then there are certain problems if you are a registered intermediary with the regulator, that beyond a particular date, I would not be able to liquidate my position because I have given advice or something. That is it. The point here is this, that Rohit, you do since you do fundamentals, you do technicals, you do economics, you just study this return on capital. Return on capital is the most important thing, most important thing. And if it is below 15%, those companies simply don't stand a chance. We are small. I mean, I consider myself as a small investor. I'm not setting up a steel plant or something. So my money, I would like to put it where the return on capital would be pretty high, because return on capital minus the cost of capital, is the free cash flow, and the free cash flow to equity. That free cash flow to equity is what I as a shareholder have access to. And that's the reason I personally do not look at stocks below 25 ROCE. But if somebody is still willing to buy stocks at lower return on capital, then at least seek 15%, not anything less. No way. Aries Agro, great stock, going up, crazy. But look at the return on capital. Look at the return on capital of a stock like Gravita. There are lots of news circulating about Aries Agro, Gravita, and stocks like that. But look at the return on capital. You will find that these stocks actually has moved up. Gravita as a company, it is too very highly skewed towards lead and doesn't generate as much return on capital. So if you are buying when there is going to be a serious correction in the market, then these stocks will be butchered going forward. These are the stocks that actually generate very low return on capital. They would be just left out from the investor's hand like a hot potato.
Yeah, I think the calculation makes you remove your cost of funding, and then what equity shareholders.
Yeah.
From that angle, then it makes sense.
Yeah, basically, what I'm telling you is what McKinsey follows. I mean, it's not my thing. I've learned it from reading books. Of course, even Saurabh Mukherjee uses that. But I mean, it was there in Tim Kohler's book, Valuation, Managing and Measuring uh, Valuation of Companies.
Right. So, what I'm going to try and do, we have a lot of the list here, a lot of in the last actually do questions.
Rajata, if you can go on mute, please. Yeah. I think there's an echo from your side.
Yeah. So I'll just try and bring in people who are on the list to ask their questions and then get the conversation going from that point of view. Jitendra Singh, I think you're in the speaker list. If you have a question, you can throw it.
Yeah, hi Rohit and Rajat ji. Rohit, hi. I mean, whenever you speak, I do listen with a lot of care. I just had one question which is into two parts. Part A, what set of circumstances or developments would make you change your view or make you rethink about this up and down market view which you have currently? Part two is that suppose we consider this to be an up and down market, and at some point a corrective phase does set in, but it is more of a time correction rather than a price correction. At what levels, or if there are any levels, you would think that, again, a rethink that this is not an up and down market, but can turn into a bull market would come into play. Thank you.
Okay. Uh, I think we question this almost every day. I have to spend time reading a lot of macro research and understand if anything is changing on things like the trajectory of rates, things like the trajectory of the dollar. What is happening to the US economy? Will it further slow? Is this really a bear market of larger degree, or was this just a routine correction? So I think this is a daily question we ask, and then so there are two ways we do it. One is, of course, we try to, when we are looking at the big picture, then we are studying the logic behind it and reading a long report. Then when we are taking quick decisions, we open charts, okay, and we look at critical things like bond yields across the board. I spoke earlier about the dollar breaking out about above 104. So then, very simply put, if the dollar index in the recent fall did actually go below, say, 103, then it would start defying the thought that, well, was that breakout a false breakout? It was just a spike, a panic, and it's over. And if that is not the case, then the case for a strong dollar still remains. Now let's take another case. 2 days ago I was speaking about a bond yield chart, and right now as we speak, if you look at the Spanish and German, which is basically European yields, I think after the Bank of England raised rates initially, they didn't react, but now these yields have just jumped up around 14-15 basis points, all breaking out of triangle. So we look at these things, and if I start seeing that no, the trend in yields across the board, different countries, is still higher, then I have really not seen a reversal in the bond market that people are really calling for. So now there's one. So that trend has not changed. So that's one underlying risk. And in the Indian bond market, we could say around 7.2%, 7.15%, because that's been the range, or maybe even 7.1 if you want to put the worst case. We made a low in September, which was at around 7.106. So let's say if we go below that, we have a different case. But right now, even in the recent decline in yields, we haven't gone below that. So nothing has changed there either. Same way I spoke about the currency USD INR not breaking the 20-week average, closer to 81.90, 81.80. So these become multiple factors that we are watching all the time. If anything changes, then we change our perspective. Now, okay, let's say we ignore macro. So some people say, why are you looking at macro market? Dekho na bhav dekho. I say, fine, I look at price, but I look at price across time frames, which means that if I end up looking at a monthly chart of the Nifty and I end up seeing that the monthly momentum indicator which we use, which now I coined as the Rohit momentum indicator, or the RMI, but something that we've been using. My teams have been using, Jay, Sarvendra, all using variations of this system. The monthly indicators are in sell, okay, and now when we think of it as in sell, there are two things which can happen. The 2002 to 2008 bull market stretched without really breaking, say, the 20-month average. So a lot of last year we were actually debating this in all the weekend episodes with me and Chavan. When I was bullish, I was saying, well, if the 20-month doesn't break, then it's a good thing. We did close below it once, and then we went back above it. So now the argument can be, okay, then it didn't break, right? So shouldn't we be bullish from a 7-8 year perspective? But everything, if we really compare it to 2004, when it fell back to the 20-month average, it was a 61% retracement. Valuations were like less than 15x forward earnings. It's a very, very different scenario if you put all the things together. The rupee was strengthening, not weakening. So you didn't have the same factors in place as you're having now. So when you don't have the same factors, we start questioning, will this happen? Now we are still within this range. We have not really gone above 18,600, okay, by a few hundred points, but it's not like a big move up to the upper. I mean, say for example, we can use Bollinger Bands. We can say the upper monthly band is at 18,800, 900. So we didn't really surpass these levels to say that something has really changed. So if something has not changed and we have all these doubts, then we retain that the monthly cycles will continue to remain negative, and this is not a runaway market that is going to hold based on these levels. So these are all the factors. We are looking at many different things from many different angles and try to put it together and answer the question as to whether we should continue to call this a trading market or should we go into a bull market mode. And being sure is more important because see, we can always say that okay, if 300 400 points higher or 1000 points higher, if it's still consolidating, we can always get back into this market. I mean, to me, any bull market is not something that stops at 10% higher. I mean, what is 19,000 and 20,000? So if somebody comes and trolls me and says, 20,000 jayega, we're fine, 20,000. What is 20,000? We started this bull run at 7,500 or 8,000 or 9,000. We doubled from there. Historically, all bull markets in India have doubled within 1 to 2 years. You can go back to 2004, go prior to that, go after that, 2009 bottom. By 2011, the index had bottomed at 2,200 and come back to 6,000. So this is what we've seen. I think the lowest growth phase from a Nifty perspective was between 2011 to 2018, where the Nifty really went up by barely 8 to 10% per annum, and people started to believe that like that is the new rate of growth for the Indian market. But for a growth market like India, where GDP can grow at 8, 9, 10%, I don't understand a 10% CAGR in Nifty being attractive. So I sense that unless you can really think that the index is going to double from here, and if that is true, then what's wrong at buying at 20,000 if you're sure that the currency and bond markets are truly reversing course from here? But right now, we don't see any signs of that, and therefore, taking that additional risk doesn't make sense. So I think that's a long answer, but try to put it from various angles as it will come from different people might have questions on that front.
Thanks, Rohit. I just have one little bit for Rajatda. Rajatda, one question to you. Liquidity is usually the joker in the pack. So, considering the fact that EPF and ESI see money is also going into the markets, and there would be an expansion of demat accounts with more, cash coming from savings into the equity market. Do you think that would be the joker in the pack and upheld this, or put a stop to the correctiveness in terms of price in this correction, and we might get into a prolonged time correction on this? And thank you to Rohit and Rajat.
Well, what I would say is that if you go to China and study what happened in the early period, first decade of 2000, similar kind of situations happened there also. But then the Chinese market, because even when the correction was warranted, it did not happen because of instruments like SIPs, stuff like that. Were- this money, extra money that came in, that was sucked in the market. But after that, when corrections really happened, that was very nasty. So extra pumping in money, you are actually delaying the inevitable. That is the kind of scenario that will, it can always happen. I mean, nobody can say that it cannot happen. I mean, but the farther you delay the inevitable, the nastier it will be. That is the point. I mean, I'm studying Jim Grant, that is James Grant, and his books. I would urge all of you to read that. Read those books. You will see a lot of patterns. And James Grant said one thing there, that we don't commit the mistakes of our fathers or parents. We commit the mistakes of our grandfather, because the grandfather's mistake we don't remember. We have not seen that, so we suffer that. We commit that. But father's mistakes, we are the sufferer because of the mistakes committed by our fathers. So if you study history, you will find parallels. You will find parallels. You study the history, US market history, it will give you lots of cues. You study what happened in China, you will find a lot of things very similar. See, one thing, there was a time when Mr. Liu, who was then the equivalent of a railway minister out here, he said that a particular railway, huge investments in railways, and one particular space where there had been mountains, they took up a project to cross the mountain and make it a flat land in order to continue to grow infrastructure, grow everything. But ultimately, what happened was the same person was charged for taking wrong decisions, and also added to that some other mischiefs, maybe wrong investments, getting cutbacks or whatever. He was given a death penalty. Later, that was converted into lifelong imprisonment. I mean, lifetime imprisonment. Here, you must have seen that infrastructure is the need of the hour, and so lots of things will happen. Capex cycle coming in. This can delay the inevitable, but it cannot. Interest rates are the real drivers. So if interest rates are not, and interest rates sooner or later the world moves in a similar direction. You cannot have a pocket. You cannot have a pocket where interest rates are actually going down and rest of the world interest rates are going up. It cannot happen. So that's why you are talking of a time correction. No, time corrections don't happen. If time corrections happen initially, if you find it is a range bound situation, then there would be a waterfall like fall. You will you will experience another COVID kind of fall, that February 12th to about March 24th, 2020. So I would rather prefer something like 1994 Sensex top to about May 1995 bottom, a steady fall coming down. At least to get an opportunity to get out, rebalance your portfolios, things like that. I hope I uh, clarified my view.
Yeah, thanks.
Nilesh Dedia, you can ask a question if.
Yeah, hi Rohit, and hi everyone on the panel. So, can I express some of my views on markets, if
Sure,
I'm allowed?
sure.
So, when I see Dolex 30, BSE Dolex 30, uh, eventually it has not seen a higher high, and eventually what I saw it today, we are into a head and shoulder type of a pattern against Nifty. So that's not a healthy sign. So from here, USD INR we can see a decent jump, probably to 85, 86, 87. And when we compare to the US 10-year bond yield, 3.30, 3.40 here, I think there will be a pause and again a rebound for a new highs. So this is my perception. And even dollar index, I would be looking at on a monthly closing basis, because we can have this kind of whipsaws where we can see 103 and then suddenly we can see 105 and everything would be changing. So monthly closing for all the benchmarks would be very, very important. Immediately 18,750, which is monthly close of November, I don't think so it should be crossed out. Uh, and if we close below something below 18,000, I think the confirmation would be there for the correction in happening. Now, how deeper this correction can be, or how that is a big question mark. It can be in phases, it can be in slices, yeah, and it could be that we could be at the terminal point also, because as per the observations, a lot of penny stocks have been moving, which always happen in December when FIs close their shop. The smart money comes in and do all this juggling. So the more picture would be clear would be after once the results dates are announced and we come across actual results where HCL Tech has already given a warning. So the IT pack would be the first one, and coming from the price to book value also, markets are not into a healthy mode. Price to dividend yield, markets are also not into healthy mode. So 7.5%, 8%. If you're getting in fixed deposit, why people will risk equity at 10% or 12% CAGR? So this is my whole nutshell.
Okay, that's
Yeah.
fair. There, since you spoke of valuations, the only one parameter on valuations which requires adjusting to understand is the PE ratio, because we actually changed the way PE ratios are calculated in March of 2021
Right.
at consolidated earnings, which brought down the P, which was at 30 plus, comparable with the historical. suddenly all the way to mid 20s. And so from there on, when we actually making that comparison on P ratios, it actually becomes difficult sometimes that should I compare the same with the past, because it may not be the same. And that's where I sometimes get lost. The next time it's at 9, is it really 9 or 15? Is it really 15 or is it something else?
So the best way, Rohit, is to look at price to book value and price to dividend yield. That's, I think, the best parameter. And also, we can take reference from Buffett indicator, which is also not showing a healthy sign, where returns would be max 3-4% from here, and downside could be to the mean reversion. So we can take the reference point from there also. So
This
as you said,
market cap,
20,000. Pardon me.
you're talking of market cap to GDP.
Yes, yes, yes.
So where would that be historically in your reading?
So from here, it would be 3-4% higher. From here, if we take last 10 years data,
Is it 100, 100%, 150%? What is the number actually? That's what I was asking.
roughly it is somewhere around 103 or 104. The
Okay.
highest what we have seen is somewhere around 115.
Okay.
Lowest what we have seen is somewhere around 60 to 65. The mean reversion would be around 80. So that's whole point.
Got it.
Yeah.
Karan Sarin, you have a question?
Yes, very good evening, Raj sir, Rohit sir, Savinder sir. So, couple of questions. I would like to know your view here. So, sir, being, am I audible, sir?
Yeah. Yes, you're
Audible,
audible.
right?
Yeah.
Thank you. So, sir, one being IT. I had the question. I had this question because IT, you know, did a good bounce. It had a very good bounce here, right? So, IT. People started talking about like it's going to touch this all can touch an all-time high and all, and cut to and it fell 2 days straight. So IT view, sir, here, Nifty IT and the large caps and the mid caps. Would love to know Rajat sir's view, your view, and since we are at we are at very high valuations here. So what do you think will be when exactly do you think will be a good time to fresh investors to come in, like as in fresh investments to come in and fresh investors to come in? So these two very brief questions, sir. I would love to know it. Thank you.
See, my only view on IT is that it highly correlates with the US tech index and tech sector, and also with the US economy. So in that sense, I would think that there is still downside risk to IT. We've seen one very significant decline. You'd start feeling that maybe this was an opportunity to buy into this dip after such a big fall. Structurally, at least when I look at some of the stocks, they look like five-wave declines, which technically mean that that was just the first wave of selling in IT. And after you get a bounce, they fall again. The only question is how much can they bounce? Now, they've already bounced a bit, not a lot. I would have liked to see a bigger bounce, but it's not a necessary requirement. And that said, if the next leg down starts, which I think we are closer to as far as US indices are concerned, then possibly the IT sector rolls over again from here, and there would be again another round of meaningful declines across the sector. That is what I am sensing. I mean, the external sector, which is related to exports, is where the most risk is. That's to put it in short.
Yeah, I personally would like to say that, uh, go just to add to what Rohit has said, that say Infosys 1620 to about 1680, this kind of range, it needs to take out, and I'm not expecting it will take it out, and the earlier low can be broken. Uh, I was estimating that a significant support area would be around say 1250 or something. So in similar proportion, the other biggies among the tech sector will go down. But I personally would not be able to talk about stocks like Affle India or Root Mobile because I do not understand those businesses very well, and only technicals would not be really right. I'm true, Rohit.
Rohit Goel, you want to ask a question?
Hello.
Yeah.
Yeah, yes, sir.
Yes, go on.
Yeah, good evening. Hello.
Yeah, go on. Ask your question.
Yes, sir. So I was just seeing the Nifty charts for the last 10, 15 years. So every year, irrespective of even if we fall in the first half of December, like from the 20th to the 31st of December, or maybe first week of Jan, we get an up move. And then maybe after the first week of Jan and through Feb, March, it falls big. I mean, so like even I just read the Nifty daily today, as you said, wave three is going on. So is it possible that maybe we go to 18,000, 18,100, then we have a bounce, and that would be a good idea to short at? And also, which would be the best stocks to short apart from IT
Uh, Now,
or sectors? I mean,
first of all, I'm not going to make stock specific comments.
yeah, exactly. Yeah, so sector like,
See, my sense is that if I think about the last 1 year, it's a distribution phase. It's a repeat of what we've seen between 2018 to 2020 in a slightly different way, where
right,
one sector at a time has performed, and now you're probably seeing some kind of rollover.
right.
Okay, so when we see that,
Hmm.
we end up uh, thinking that once each sector has peaked, like I wrote about in the long short report, I showed the chart of power, right? You'll see
Hmm.
thing happening in many charts where sector indices have stretched, but their monthly momentum is diverging negatively or in sell mode and slowly rolling over at this point of time. So you'll end up in a stage where all sectors decline together. So that
Okay.
very different picture from the one that we are seeing right now, where
Hmm.
some sectors performing, many have declined in the last year but have not picked up again, like IT, which we discussed. And
Right.
on the other hand, there are some which have bounced a lot more, like metals, and then those which are outperforming, like PSU Bank. So there's this whole gap between different sectors, and I think once you're past this distribution phase, because we are seeing global tightening of liquidity, so let's not forget the backdrop, which
Hmm.
tightening of liquidity conditions around the world, including India, which the RBI is saying they will do. I'll have to believe that they'll finally do it, uh,
Hmm.
or else the markets will force it through the currency and bond market. And when that happens, I think all
Hmm.
sectors decline for a period of time. So you're at that point where every sector will fall. Uh,
Okay.
we may get relatively okay. Will this fall relatively less and that fall relatively more becomes the only debate. And if I go back to say 2000, I remember that there were barely very few stocks. I think apart from say an HDFC Bank or an Asian Paints, which I can remember between the 2000 2001 bear market where many stocks lost 80%. These
Hmm.
stocks that actually did not fall throughout that bear market. So when you see that relative strength, then in future I can always say, okay, these are strong stocks which I can get into. But today, at this point of time, to say that there will be strength in some particular space but expect the market to fall meaningfully from here is very difficult. So I would tend to believe that there will be a broad based decline. uh,
Okay.
the only reason you have seen outperformance is the market has actually rallied back, right, from 15,200
Right.
to 1,000. If you had a falling market, then you wouldn't have seen this kind of outperformance in sectors. So
Right. And as you said, for the past 2 years, we've been having like कभी PSU बैंक चल रहा है, कभी autos, कभी banks, कभी IT. So there was this rotation thing going on, and we were going higher on the index. But okay. So now the fall which you are expecting is will be broad based, as you said.
yes.
Okay. Okay. Right. Fine. Yeah. Thank you, sir.
Okay, thanks a lot.
Yeah.
uh, Vijay Solanki. Vijay Solanki, you have a question? Okay, if he's not able to speak, Aditya Utkarsh.
Yeah, I will speak after 2 minutes.
Okay, fine. One sec. Sharadji, I've been trying to add you as a speaker. I've sent it to you right now. I hope you're able to join. Uh, you can share your views or ask any questions to the people in the room. Sharadji.
आज मेरा बर्थडे है भाई.
Arey, many happy returns.
Happy birthday, sir.
So I guess you will allow me to speak for 3 hours.
सर पार्टी आप किधर दे रहे हो वो भी बता दो साथ में, वो 3 घंटे के अंदर फिर हम आ जाते हैं उसमें.
Yeah, first of all, I have early stages of Alzheimer. तो वो 1929 70 का याद नहीं है. इतना याद है कि अप्रैल 2019 2020 फरवरी तक निफ्टी 12,000 या 12,500 के ऊपर नहीं गया था कम वॉट में. तो 30 साल में नहीं हुआ. फिर ये कोरोना के बाद में लिक्विडिटी आया, बढ़ गया सब कुछ. बच्चा पार्टी लोग आ गया, ये भी ले लूं ये भी ले लूं, यही चलता है ये 2 साल से. My only point is Nifty will be 12,000 कम वॉट में. जो इतना साल क्रॉस नहीं किया वो अभी क्यों करेगा भैया. लिक्विडिटी जैसा ये रजत भाई बोला, लिक्विडिटी इज ट्रांजिएंट और अपना मार्केट कैप है 290 ट्रिलियन रुपीस. मतलब दो सौ कितना होता है 290 लाख करोड़. अभी उसमें 15,000 आया ESI का कि नहीं आया, क्या फर्क पड़ने वाला है. So that is out of question. Second point, I don't agree with Rajat ji कि ROC, ROE कुछ काम में आता है. वही स्टॉक पकड़ना है जहाँ पे ग्रोथ है. That's it. ROE को छोड़ दो, जहाँ ग्रोथ दिखता है पकड़ लो. Third thing, India has not grown, as Fact Finder was mentioning to me. 2080 auto numbers, 2090 auto numbers are the same now also. So where is the growth? Air traffic, the numbers are less now. So we are living in a lala's land. Everybody is making fool of us, all the operators, promoters. Secondly or thirdly or fourthly, first quarter GDP 36 lakh crore. Very good. Second quarter GDP 38 lakh crore. Very good. November GST collection 146 lakh, and in October it was 150 or 152. In December I it's going to be less. So in this scenario, how can a market remain where it is? Secondly, if anybody has some common sense, I'm not saying a lot of common sense, some common sense, such high price PE shares, why would anybody buy? For example, I wrote about this Polycap. अरे पागल है क्या, 50 का पीए में एक एज 4-5 का पी होना चाहिए. और लास्ट में बोलता हूँ बेच डालो सब कुछ, वरना ऐसा पछताओगे। ये सब चक्कर में रिटर्न ऑन इक्विटी, ये वो कैपिटल, ये कुछ मत देखो। एंड पीएसयू बैंक्स, यूनियन बैंक जब 400 का भाव था, उस टाइम उसका जो मार्केट कैप था, और अभी जो मार्केट कैप है वो 5 गुना है। मर्जर हुआ और कितना इक्विटी डाइल्यूशन हुआ। तो व्हेन यू बाय अ शेयर, लुक एट द मार्केट कैप एंड देन बाय। एंड प्लीज, यू डोंट अंडरस्टैंड इक्विटीज, क्योंकि 45 साल हो गया, फिर भी मुझे 30% ही समझ में आता है। तो आप लोग तो नए नए हो, जाओ म्यूचुअल फंडों में। लेकिन अभी मत जाओ, अभी रिडीम कर दो। एंड रोहित भाई, वन लास्ट थिंग, ये आपका ए बी का सी का डी नहीं होता है, स्ट्रेट 12,000 ही होता है, समझा? भी होएगा, ए बी सी मत लाओ बीच में, बार बार बार।
Sir, Madam, that is our science. I'll have to follow my
नहीं नहीं, वो
science.
ठीक है, लेकिन हमारे हमारे को तो गणित आता ही नहीं है।
देता हूँ ना, 61% रिट्रेसमेंट पूरे जो राइस का 7,500 से लेके 18,600 का 61.8%, 11,800 आता है, विच इज वेरी क्लोज टू योर नंबर. सो लेट्स होप वी कैन सी दैट.
अभी तुम बोलता है तो ठीक होगा, वरना कैलकुलेटर लेना पड़ेगा मेरे को।
नहीं नहीं नहीं, बिल्कुल सही नंबर है.
एंड सी वन थिंग, भारत मेरा देश है, भारत एक महान कंट्री है। इसका मतलब नहीं है कि आप महान वैल्यूएशन पे शेयर ले लो। आपको शेयर लेना है सस्ते भाव में, चढ़ चढ़ के मत लो, ऐसा पछताओगे 40-40 साल निकल जाएगा। मैंने बहुत सारे लोग देखे हैं जो शेयर सब पकड़ के बैठे, अभी भी वो सब ब्रीफ केस में है, सब फिजिकल, कुछ होता नहीं है। इक्विटी मार्केट खाली उल्लू बनाने के लिए है। वो प्रमोटर को शेयर बेचना है, आपको लेने का है। दिस इज द फंडामेंटल रूट। हाँ, और लास्ट बात, ये जो बाजार है, इट इज नॉट अ फ्री मार्केट।
Can we hear Sharad sir or not? I can't hear Sharad sir.
I can hear him.
I can hear him too.
Okay. So I was saying, this market is a rigged market by the government of India.
I think I can't hear him.
Okay, just check your connection, sir. I mean, I can hear you and I can hear him.
I
so
can
I
also
don't-
hear him.
Uh,
No, I was only saying this market is rigged thoroughly by government of India. Don't fall for it. You will be in great trouble. That's all, Rohit bhai. Thank you for the opportunity. और हो सके तो सिखाना यार, ABCDEFG.
Surely, sir, आप मैं कॉल करता हूँ, आपसे मिलना
नहीं
बात.
नहीं, बाद में का आता है मेरे को, EFG के बाद आता है. Okay.
Sure. Now, अच्छा, Gordon Gecko, would you want to ask?
Yeah, hi. Good evening, everyone. Hello. Good evening, everyone.
Yeah.
Yeah. Actually, I didn't have so much of a question, more of an observation. I was listening to Mr. Bose earlier, where he was talking about the ROC and ROE and how it is important to have ROCE at least greater than 25. I had an observation on that point. See, I personally am not a fundamental investor. I'm essentially a hardcore momentum investor. So I never look at these ratios while investing. But since I had also read a lot about these things from various sources, what I did was, and I just wanted to share an observation that what I did was among the stocks that I had in my portfolio, which were selected purely based on price action momentum, I went back and checked their ROC just out of the sake of curiosity, as to how it is sort of aligning, and I was sort of little pleasantly surprised that stocks which are very high in momentum also tend to have a very high ROC. I mean, it could be the other way around, but since I initially selected them based on momentum, so that's how I correlated. But it was a pleasant surprise that stocks which are in high momentum also tend to have a high ROC, which sort of gives you more comfort that, I mean, not that it would change any decision for me per se as a momentum investor, but it gives you comfort that not only is the stock behaving very well from a price perspective, but also has a good quality factor, behind the scenes. So that's one observation I had, which I wanted to share with everyone. So that's one. And secondly, just a small factual point. Rajat sir was making a point regarding Gravita, and since I have it in my portfolio, I had checked it. I think the ROC there is not really low. It's probably in the 30s. So just maybe maybe I'm wrong, or maybe he may be wrong, but from the databases that I use. So just a factual point. So thank you very much, and thank you for the opportunity.
Can I go next? Hello?
Walter Menzies, please.
Yeah. Yeah, I wanted the observation of the team on dividend stocks. In India, we don't see very high dividend paying stocks. But is there a place where we could refer to who keeps track of the dividend growth of some of the stocks which offer a very high dividend? When I say high, I'm looking at in the range of say 4 to 7%. Like in the US, you have AT&T, for example, which will give you anywhere between 6 to 7% on dividend, right? And so what's your view on dividend paying stocks in India? And where can we refer to, to get a constant view of dividend growth in stocks so that we can pick and choose the right ones for us? Thank you.
So, one of the hot sectors of this year have actually been PSU stocks, which are high dividend yield stocks. Sometime back in 5 or 6 months back, when Coal India was still at 150 rupees and they had raised their dividend, the yield was coming almost to 10%. And so I'd made a mention that, if you're getting a yield like that, which is more than what you're getting in the bank, then what's your downside risk? So you have to look. I think PSU banks have been one of the value plays of the last year, where this whole value versus growth argument was going on. A lot of money is chased value where there is dividend yield, which has been PSU stocks. That is just my small take on it.
Anyone else who has some thoughts on dividend? Thanks for that feedback.
Yeah.
All right. Thank you, everyone.
Aditya, if you want to speak, because I really need to add other people, there are a lot of requests pending, and I cannot add anyone without removing someone. So if you have a question, take it right now. Aditya, Utkarsh.
Can I just clarify Gravita ROC?
Yes, please.
See, Gravita ROC, March 2018, 23%, 13%, March 19, 19%, March 20, March 21, 21%. Only this time it has moved up to 31%. Actually, this kind of highly fluctuating ROCs. That means I'm not saying that Gravita is bad or good. No, no value judgment here. Only thing is that this kind of wild fluctuations in ROCs indicate that this company does not have competitive advantage that way, or it is skewed in one particular product.
Rajat bhai.
Bharatji, I would like to tell you one thing. I would like to tell you one thing. However much you say, return on capital does matter. return on capital does matter. Probably we can sit one day and discuss that.
अरे आप सुनिए ना, मेरी बात सुनिए ना. ये सब ये छोटा छोटा कंपनी है ना, तुमको क्या मांगता है वो दे देगा. ये देखने का है ये दे देगा, ये देखने का है वो दे देगा.
हाँ, ये सही बात है.
हाँ, तो वो मैं बोल रहा हूँ. तो ये सब कंपनी का फालतू में काय को डिस्कस करता है. ये छोटा छोटा कंपनी का छोड़ो ना यार. अच्छा लगता है तो
नहीं मैंने वो अरे अभी 31% मार्च 22 में दिखाया, बट कोई भरोसा नहीं है कि वो हाई डिविडेंड हाई आरओसी मेंटेन कर पाएगा. वही मेरा बात है.
डिविडेंड दिया क्या उसने?
They can't give dividend, guys, because the company doesn't even hardly any generates only cash. So Rajat, you're right.
Yeah.
Cash flow from operations has fallen by about 80% in the last 4 years, while the profits have gone up by about 300%. But there is no cash flow. There's barely any cash flows. Everything is going into inventories. Inventories have gone up by almost 600%. So, yeah.
भाई इसके लिए बोलता हूँ, ये सब फालतू का चीज है. जो जेन्युइन कंपनीज का आप बोलते हो ना, आप सर आंखों पे है, पर एड़ा टेढ़ा कंपनी का कोई मतलब नहीं है इधर.
सही बात है.
ये सब अभी जितने भी लोग हैं समझते नहीं है कि ग्रेविटा वो नाम लेगा मैं फेंक देगा. बट ये लोग को इन्वेस्ट करना है उसमें, अपने क्या करेगा? अपने रोक तो नहीं सकते हैं.
Aditya, if you have a question, do ask it now, because I need to add other people, and I'll have to remove some people, otherwise I can't add. So Aditya, Urkash, if you're asking something, ask it now. Okay, so I don't get any response. Harsh, Trendonomics, you want to say something?
Yeah, thanks, Chris, for giving me an opportunity. Coming on to the markets, whether it's a bull market or a bear market, I'm not basing my judgment as of right now, that okay, it's a confirmed bull market. Yes, a lot of indices have broken out. A lot of sectors have broken above the 2021-22 highs. In terms of Elliott waves, when do we say it's a bear market rally? When a couple of sectors doing make new highs, but the index does it. But what we are witnessing right now, like many indices have made new highs than the previous highs. Like auto index was the star performer. PSU bank index is performing. Capital goods sector is performing. A lot of metals is almost back to the high, and couple of indices, power sector, and couple of sectors are breaking out of multi-year of consolidation. So all these sectors, metals, power, capital goods, and all infrastructure, even real estate, were in a multi-year of a downtrend post 2008, and for the first time, many of these indices, like metal, cap goods, and all of these, made all-time highs. First time in 2020. So traditionally, what as a technical analyst, what we say, if some sector, if a sector or a stock is breaking out of a multi-year of consolidation, it does not just stop in 1 or 2 year of rally. It goes for a rally for at least 4 to 5 years. So as far as that is concerned, the 2020-21 rally, what we saw was not the end. That was just probably the first part. And then we saw a bear market or a correction. Now the question is whether that correction is already over or not over. So that question still stands unanswered, because yes, we still have to break highs in a couple of indices in like IT and mid cap, small cap indices haven't broken the highs. So I'm not concluding that yes, we have started new bull market. Though I have the view that yes, it is a bull market, but I am not rejecting the possibility that it could be a bear market rally. Okay, but when I start believing that it's a bear market rally, so for me that comes when we start falling below 18,000 levels, 18,000, 17,800 levels. If we start falling below that, then probably I will accept that no, it was just a bear market rally and not a bull market. Uh, unless that is happening, my view remains that probably we are starting the next leg higher. Uh, and as
So,
an trader, if a rally is coming from 15,000 to almost 19,000, even if it's a bear market rally, and if I'm not participating in it, so I mean, definitely I have done that kind of thing in past, expecting a bear market rally and shorting, and I busted my account. So since then, I have learned to trade with the trend. Okay, it was almost a up and down market from last year. So ideally, I was even thinking of correction kind of maybe a 50% retracement towards 14,000, 13,500 when we started falling. Obviously, it did not happen. But after looking at the structure, then I changed my view because a lot of though index did not fell to 14,000 levels, for that matter, 13,000 or maybe 50% retracement. A couple of stocks, couple of sectors have fallen almost 40-50% from the 2021 highs. So though we did not see a fall in Nifty, a lot of stocks actually have fallen a lot. So that actually gives the sense that yes, probably that correction was over near 15,200. Another thing I want to highlight that uh, looking at the commodities, so even the CRB index has broken out of a multi-year trend. The crude has broken out of multi-year trend. Copper has broken out of multi-year of consolidation. So we saw first part of a rally, and we saw other correction right now. We saw correction in crude, we saw correction in copper, almost all the commodities. Copper again started rising back. Even the natural gas started rising back. Crude is yet near the lows, but it's confirmed that it's wave two correction going on, and it's not like end of the rally what we saw in 2020-21. Uh, uh, the only question is whether the correction is over or not over. So that for that definitely I will wait to conclude. But one thing is I'm thinking is if the correction is over, we are going to see hyperinflation probably, because I'm expecting the commodities to rally again, commodities to double from these levels what we have, provided that the correction is over in commodities. And you seasonally or historically, we always seen stock market and commodities rallying together. We have seen it in 2020-21, commodities and stock market rallying. Then obviously for some months there was a divergence. After October, stock market started falling, Indian markets, but the commodities kept rising because of the geopolitical issues. But on a longer horizon, both stocks and commodities have a positive correlation. So now the question whether the commodities start going up again, and that will confirm that yes, it's a bull market, or commodities continue to fall and stocks also continue to fall. So for that, obviously, I will change my view once stocks Nifty starts falling below 18,000 levels. Probably I will then start thinking that okay, I want to short, I have to short because the trend has changed, and maybe I will sell my portfolio also because obviously I'm a momentum investor. I don't believe in buy and hold because I have seen underperformance for years by holding the stocks. So I never hold the stocks unless until the stock shows me a performance. So for me, it's more of like riding the trend. And for the last 1 year, I have been going through up and down market, riding on both sides. Though currently I have a bullish view, the views are subject to the price action, and I don't have like a fixed bias that okay, it's a bull market and we should be rallying. Though I believe it is, but obviously if the prices tell me it is not, I have to accept. I don't have any other option but to accept. So that's my view. Bond yields, I don't have to say any much, because I don't know whether these are topping out or not. Because if the commodities start going up again, probably bond yields also start rising. So we might have a hyperinflation kind of thing. One thing I am looking at is dollar index. So actually last year I started going bearish when the dollar started rising from 90 levels odd. I was little early to call for bearishness. That's okay. But now the dollar has started falling down again. So that gives me a sense that okay, now since the dollar has reversed, there is a probability that yes, we the stock market should continue to go upward. 103 is the level we have to see weekly and monthly close below that. Then I will again conclude that yes, probably we are in a bull market and we should continue to rise higher. So my thesis is now on dollar and of course Nifty levels of 18,000. Dollar breaking 103 levels, I will continue to be bullish. Nifty breaking below 18,017,800, I will change my view to bearish.
Understood. So, Harsh, see, the only thing I'll add is, like you said, dollar. So, that is one of the key components both on taking a commodity view. Because if the dollar turns bearish, that's when your commodity price rise, the next bull run in commodities happens. But till I can really confirm a dollar bearish view, the impact that a rising dollar would have is again keep the pressure on commodity prices, which is why the inflationary cycle for especially hyperinflationary, as you're saying, which completely depends on governments going out on their sovereign debts and trying to inflate them away, which is something they didn't do. They could have, but sort of appear to have backed off from at the moment. And the other thing on sectors, which we were saying in the beginning, see, if you actually study, the right thing to do for this period is study 1990 to 2000, which is when we went through a similar consolidation across sectors, whether it is capital goods, power, metals. All of these sectors went through 7-8 year kind of a consolidation phase between 2000, 1994 and say 1998. And then in 1999, during the Y2K bubble, many of these sectors actually broke out, just like they are doing today. And it starts to look like, oh, they have started something new. But because you had this global tech bubble unwinding, we went through a deep correction in most of those sectors. So we are seeing something similar, if you ask me, that all these breakouts we are seeing in sectors are real. But the question is, we are still facing headwinds, and that is why while it may mark the start of something bigger, you can get a correction in between, which is what we are really trying to get a fix on.
Yeah, right. Because I don't have charts of those. I don't have that data of 2000, 1990, 2000 for all these sectors. So I don't know. I cannot comment on that.
Yeah.
Actually, yeah, because even I was not in the market at that time.
Yeah, if you can get it and study either on Metastock or Reuters, some source will have it. I think most of the charting packages nowadays data starts from 2000 or so, especially investing in also. Actually, yes, you don't get the prior period, but it is very, very similar. So having been there, I can tell you BSE indices do have more history. So if you actually study BSE indices versus NSE, you will find much more historical data than the NSE indices. So that's my input. Now I'm going to move on, Harish, to the because we need to cover more people.
Yeah, sure. Thanks.
Super Dhasu, you want to ask a question?
Hi, Rohit.
Yes.
Can you hear me?
Yes.
Okay. So first of all, thank you for the last, I think, 10 or 12 years that you've been mentoring in the virtual world. And I've been very fortunate to have discovered you. And then about today's morning star and evening star theory that you had shared in the daily update. My question is only about the reality market, and I think Trendonomics just touched upon the subject also. We are seeing a very large sort of a consolidation phase of the last 10, 12 years, and the leading stock which has the highest weightage in the Nifty Reality Index being DLF. And considering I'm the northern side of India, I see DLF doing a rampant job in kind of launching projects and getting bookings and being overbooked, and almost people getting lottery tickets to buy apartments, which are worth multi-crore, 5, 6, 7, 8, 10 crore rupees. What is the breaking point of the real estate sector, and what sort of a lead lag do we see? Because in the 2011, 12, 13 period, when interest rates went up to 10% on home loans, the reality market, and I'm talking about asset prices, not exactly the stocks, kept going up. So, how can we sort of see the correlation between both the indices as well as the real asset prices, considering we are in somewhat of a sticky inflationary sort of a market, and asset prices, hard assets, are bound to go up. So, both from the index side as well as the physical asset, what is your large reckoning? And I think I would like Rajat and maybe Fact Finder to also touch upon this if they can.
I'm not sure if I got the center of the question. Sorry.
Okay, so the question is asset prices, which is land, say for example, uh, lead lag with interest rates, and thus index, which is the stock of the real estate businesses. Uh, how does it correlate? Is there a lead lag with equities, commodities, interest rates, and the like?
So one classic cycle which I think I've written about is the bond equity commodity cycle, right? In which you can add real estate also. Real estate tends to lag equity, so it will be very much in line with what commodities do. So bond markets are usually the first to top or bottom out. Equities are second, and commodities are third. That's typically the cycle. It is more obvious in the topping process. So if you go back and look at any peaking process, you'll find bond markets peak first, which means interest rates start rising while equities are still rising late in the cycle. So that is what we saw, say, between 2005 and 2007, or you saw it right now between 2020, 2022, where bond prices started to fall after the pandemic. Rates were rising in terms of bond yields, and then equities were still going up when bonds are falling. Now, eventually, then that reaches a trigger point where falling bond prices also trigger equities, and both start falling together. The last one then to rise as the safe haven is commodities. So they tend to rise with a lag. Even after equities roll over, you find commodity prices are still going up, which you'll find oil prices going up in 2008, even after equities had peaked in early part of 2008 till June, July of that year. Oil was still going up to $140. Now, the same thing can be seen last year also. Oil went up all the way till April, May, June after US equities peaked in January. So commodities tend to have that lag effect where they peak out a little later. Same with real estate. Indian economy peaked in 94, 96. I'm going really back. 96 is where the Indian real estate peaked, and after that, most of it was down by almost 40 to 50%. So real estate also lags the equity market by some amount, and so that's the typical business cycle, where these three things lag. So usually at the bottom end also we wait for bonds to bottom out first, where yields start going down, but equities are still falling, which looks more like a risk off trade, and then eventually equities bottom out, and then commodities bottom out. But at the bottom end, because panics often occur, it may appear that equities and commodities sometimes tend to bottom closer together than they do at the top.
I can add a few points there. So
Yeah.
this time it's very classic. Usually, as you will also right from 2000 to 2008, 11, 12, I think everything was almost in tandem, right? So so after studying Murphy, we used to think when will this bond, equity, and commodity cycle will be very apparent, and we can see that rotation and that lead lag. So I think this time it's very very clear. So if someone has a chart of the 10-year US bond prices, you can go and check. We topped out in I think March of 2020, right? Where the equity markets almost went all the way till Jan 2022. So it's already, if you can see clearly, 15 to 18 month kind of a lag on the equity markets while topping out. So you could kind of extrapolate and say that the commodity piece could actually keep on rallying for another 3-4 months, because equity stopped out probably, we'll say that Jan 2022, so you can put another 15 to 18 months there. So I think the commodity piece could probably get into 2023, and I think towards June you could see top on the commodities also. Individual commodities are doing their individual bit, but by and large on the index, with a lag of around 15 to 18 months, you could see a top on the commodities also in 2023, and that could possibly, the commodity rally could actually drive down the equity markets going up from here. So I think this time it's very copybook, and very interesting to watch. So all students of this science can keep watching it, and I think that gives you a commodity top in the second half of 2023.
Sarvendra, what you're then saying is that we haven't peaked on the commodity cycle.
Maybe I'm saying if I go with this 15 to 18 month lag on the bond and equity stop, I would also want to see some difference on the commodity side also. So maybe the commodity piece is still some steam left. Equities is what we aggressively do, but commodities also, if someone is tracking, I think that could be one piece. Another 6 months possibly there.
That
And if I correlate with 2008, in the initial decline, everything fell together. Crude also fell with equities, but after that, crude started to rally, and I think we went right from 80, 85, all that till 140, and that is where you got a steep cut on the equities worldwide. So crude could repeat something of that sort if possible. I'm not saying that's a done deal, but looking at the lead lag, if there's 6 months left on the commodity piece, crude could actually give you a nasty surprise on the upside. Because the head and shoulder is already failing.
Yeah.
After breaking the head and shoulder, coming back to the neckline every time tells me that the pattern is not up for the game, because by now you should have kind of tanked, but crude somehow wants to keep coming back towards the neckline again. So if the pattern is failing, you will see a double speed uptick on the energy or the crude prices for whatever reason that might come later on.
Yeah, I think there is some validity that if there is any commodity which is still showing signs that it can surprise you on the upside, it is probably oil. Even though in terms of wave count, I've marked the entire rise from 2020 as 5 waves. But like you said, this fall somehow is looking like, if I just draw the lows from April to October and now the most recent sell-off, all of them are on this line, which is like a falling triangular structure. And if that breaks on the upside, you end up with an oil spike. I mean, let's see.
Yeah, that would be nasty and crazy, and that could be probably the reason the market always wants to search for a reason to blame game. So I think all that will come later on, but prior to that, the markets have already started to possibly they've already started to react. Uh, the smart guys might be sensing what you and me are saying, that crude is failing and crude is not getting that downside momentum, and a larger pattern distribution pattern, when it gets failed, it gets you 2x targets on the upside. And as you rightly pointed out, the overall consolidation itself looks a continuation bullish pattern. If it breaks out on the upside, I think we are headed for trouble. And then it also marries well with our currency piece, which says that for some reason INR is not wanting to cool off, and it should depreciate possibly more, because it had outperformed till now, but now it is very sticky. Failing to go below 81, 80, 81 gives me a warning sign that every time trying to touch 83, and if you look at the forwards market today, we have already done 83 there again. So every time you want to come towards 83, 83.50, and you're not giving me a decent reversal pattern, that tells me possibly you will break on the upside. And why then 84, 85? If it is breaking on the upside, then possibly you get targets close to 89, 90 uh, for the rupee piece. So that risk is already there. And if people have not panicked till now, possibly beyond 83, I was talking to some corporate. He says, "Arey, some exporter." I said, "Arey, हमको क्या करना है? We don't want to hedge." My boss has never hedged. I said, "Boss, come on, he's never hedged. Fine. In this last leg, he will be merry. But what later on?" So I think both sides, you never know till there's a low tide. You don't know how many people are swimming without costumes. So let's see how many people are hedged and not hedged, and into this breakout, how many people suffer because of that.
Or
I think if you break
there is the wave C cycle degree theory of geopolitics, which means some geopolitical event kicks in which drives oil higher. So that's something which will be the unknown.
No, but we have always believed, no, sir. We have always believed that that news always follows price, and that is what I said at the start of Jan when we were negative in 2021 in November, December. I said I don't know what the news will be. I never knew that this is going to be Russia-Ukraine war, but later on it comes. It comes always. Bad news always comes 3 to 6 months from the time the price has already peaked or bottomed. So it is always a 1 to 2 quarter lag. So that lag will be there, and if markets have topped out now, expect bad news by June, is what I'm saying.
Any view on gold? Sorry,
Hello.
Rohit. Gold has not been discussed. Any view on gold? Because I'm expecting a turmoil in fiat currencies going forward.
So my view on gold.
Yeah, gold and silver. You'll be interesting to see.
So
Rajatda, you have to go on mute, please. Sorry.
Yeah. It's very currency specific because if I look at gold in dollar terms, it will end up reflecting the reverse of what the dollar index is doing. But if we actually look at gold in rupee terms, it's a very, very bullish chart, longer term. And that is why it's currency specific, as you stated, that you see a currency chaos. And actually, in individual currency terms, gold will appear much stronger than it is going to appear in dollar terms. I think that's going to be the situation. It's very similar to even what we saw, say, between 2010 to 2015, where the rupee weakened to 69. Gold did not fall below 25,000, but in gold and dollar terms went from 1900 to 1050, which is a significant cut. But the weaker currency helped support it. So I think that is a case. If somebody wants to own gold in rupee terms, it would probably be far safer. But do not look at the dollar price to correlate. That is where it'll get lost. To me, gold is essentially a currency hedge more than an inflation hedge. That is what I've seen over the last at least 10 years. And so that belief that it is an inflation hedge, it's an indirect. The inflation that comes from currency weakening is what it hedges. It probably doesn't hedge the pure, inflation that we get from monetary phenomena. So yes, in currency terms, in rupee terms, I think gold is in a very good position.
Thank you.
I would agree. I think the entire CRB piece where you get into go into June into the commodities index top, possibly I think precious metals will be driving that along with crude, but obvious. So I think these are the three most heavy weighted contracts on that index. So gold, silver and crude, if these three things move, I think the CRB commodity index starts moving big time.
Okay, Anant, Anant Acharya, you have been raising your hand.
Yeah, Prohit, good evening. I was just wanting to add to a few points which Sarvendra was talking about. One, that news always follows the market. As I said before, the Dow is still even today following the same pattern which it did in 2008, 2007, 2008 in terms of the time patterns. So what am I expecting here? As I said before, Dow should shave off 50% of its value from here. And Nifty, let's see, 15,200 is my first target. And somewhere around 8th of Jan, see, these markets continue to decline from here. And somewhere around 8th of Jan, you're going to get some bad news which would be tied up or which would explain the decline which is coming in today. And from now on till the mid of Jan. And somewhere around 14th of Jan, we should find a bottom, temporary bottom in the Dow and the Nifty.
Yeah.
Just my 2 bits. I don't get into all the fundamental analysis so deep and into market relationships. Keep it very simple with the chart. Yep, I'm done.
Okay. Anand Agarwal.
Yeah, sir, good evening. Thank you for giving me an opportunity to ask. Now, my simple ask as a retail investor, I have been investing for last 8-10 years and have been listening to Rajat Bhai, Saraj Bhai, and everybody of you on a various model, various spaces. My question is that now, if you look at the entire fundamental which you all have been talking about, the macro aspect, globally is not out of the woods. We are still bad on all the fundamentals that anybody can see in country, global, everywhere. So that takes the market to a bearish views, which all of you have talked about. But on the other side, for last 1.5 years, everybody is looking at that. Market gonna go down. Market gonna go down. Market always behave what mass says, against what the mass says, and in the last 1.5 year it's rallied. The second point is the amount of SIPs that flowing in the market. The last month was 13,000 crore worth of money flowing in. If this pace continue, should a retail investor be looking at that market may not fall? This type of flow of funds will keep supporting the market, sir. What do you say? So macro saying going down, the reality is on flows saying keep supporting it. What does the point of experts here?
So liquidity is the oldest reason, for markets to reach a frothy environment. You can go back to any previous market, go back to 2000. Indian economy had not picked up a lot, but the tech sector really picked up on the back of some kind of liquidity. Where did that liquidity come from? You didn't have FIIs, you didn't have so much flows into mutual funds, and it finds a source. And that time, the source was really the leverage system that was there in India. Okay, so this is my view. Anyone else can agree or differ. The leverage system back then was Badla, which allowed people to create long positions through. And just like you have futures today, you had a forward mechanism. Add to that, the NSE thought that we need to do also the same business. They started something known as ALBM that added another 10 to 20,000 crores worth of open interest outstanding in the market, which people could buy and carry forward. Add to that something which nobody will ever speak about, and so I'll mention it maybe once or so before on some spaces. The NSE did something very, very unique, whether knowingly or unknowingly, we cannot prove, but they started a different settlement system, which means they said we will run our exchange settlement, which at that time was not T+1, it was a 5-day settlement. 5 दिन तक किसी को पैसा नहीं भरना है, उसके बाद you have to pay. So the settlement would start on a Wednesday and end on a Tuesday. BSE's 5-day settlement would start on a Monday and end on a Friday. So what did the people who wanted to take very large positions in the market do? Okay, they would buy on the BSE for these 4-5 days, from Monday to Friday, then move their entire position from BSE to NSE, then keep it there till Tuesday, then move it from NSE back to BSE, in a sense not paying any margins. So you could be a large operator, you could buy 10s, 20, 30, 40, 50,000 crores worth of stock and roll it from one exchange to the other without being discovered, without paying any margin, and there you've created liquidity out of thin air, just like a bank does. So these are things that we don't realize. So how liquidity impacts markets and how it unwinds is a long story. Every bubble and every froth in history has been created with liquidity. So that is, but then something pricks that liquidity bubble, right? And right now, if US has been the creator of liquidity around the world, then they've been pricking it by raising rates, right? They've created trillions, and now they are raising rates aggressively, openly saying every time the market says no, you're not going to be able to do it. Powell is coming in, reiterating, we are going to do this all of next year. The market doesn't want to believe. So now that is the situation. You are getting a valuation correction in the part of the world where you have maximum liquidity. Now in India, we want to believe that नहीं, India में ये नहीं हो सकता है, ये सिर्फ US में होता है. India में liquidity will remain free and flowing forever, even while we watch the USD INR fall and bond yields go up. So, if interest rates go up for me, and that is my central argument, if you have a currency weakness, a currency weak environment, which is already created with your current account deficit and so on, it eventually leads to interest rates in India going higher. And if interest rates in India go higher, can you still have a weak liquidity environment as you're talking about? And the RBI, which itself has admitted in the most recent meeting that we still have 150,000 crores worth of easy liquidity in the system and we want to tighten. So let's say they do tighten, then where is your liquidity argument? So, in the history of markets as analysts, we will always find the best news, best liquidity. Everything is perfect at the top. Na bottom pe hota, to fir it's never going to be that way, right? You can never have the bad news at the top and good news at the bottom. Aisa to hota nahi hai. It's always bad news at the bottom, which gives you every reason not to buy, and good news at the top, which gives you every reason not to sell. But that cannot become a reasoning for not taking any action. So the argument you're telling me that there's a lot of SIP money coming in, which simply tells me that public at large is overly bullish, which is nothing, which is no different from what I'm trying to say in a different way. But here's another data point. This one was published by Palak Shah from Hindustan Business Line. I think I tweeted it also, and he shared that the last 6 months you're actually seeing declining participation in the exchanges. I think he's used NSE data in terms of number of investors that are active. So even while we are seeing this, somewhere we are seeing a deterioration in terms of activity. And then you should really ask the question, why is that happening? Because it's a strong market, why are you actually seeing lower participation from investors? Yeah, fact finder, you want to add something to that?
Yeah, a couple of things. I just want to add to you, Anand. One of the most important things which nobody ever talks about is asset allocation. And asset allocation, there's a very interesting, part of BlackRock, which is obviously the world's largest asset manager. So they, during the recent September conference call, actually spoke about asset allocation and how long-term interest rates affects asset allocation. So he looked at the last 30 years, because bear in mind that we are talking about a 30-year trend change in interest rates, right? And if you hear about everything as far as globalization, we are deglobalizing and nearshoring. In fact, US has introduced something called IRA, which is inflation, a rule. Basically, what they want to do is they are incentivizing manufacturing in the US. So, and for that to happen, obviously your pricing has to go up if there's deglobalization. No, the point is that what BlackRock mentioned is that if you go over the last 35 years, when interest rates used to be about 8 9 7 8%, at that point of time equity asset allocation was about 30%, and rest was debt and real estate. uh, yeah, I don't have it. Okay, so the thing is, as interest rates went down, the equity allocation went up to 65% from 35%. So somebody asked him, if you're talking about a long-term U.S. interest rate of about 4.5%, then your investment grade bonds give you about 6.5%, and your high yield bonds, and when I say high yield, bear in mind that if you look at India, for instance, India's global rating, we are at the very bottom of investment grade. It's on the border of what you call as high grade, high yield bonds. The emerging market, BlackRock ETF, which invests in bonds, as well as the JP Morgan bond ETF, the yield to maturity on emerging markets is about 8.7% dollar yield. Okay. uh, the bottom line is, if at you as a institutional investor or an asset allocator are capable under a 4% or 4.5% long-term interest rate environment, US interest rate environment, you're capable of getting about 7 to 8% dollar yield very easily. That is greater than the amount of pension returns you require. So, ideally, according to him, he said that your equity allocation under such an environment can easily reduce to about 25% from what it is today is about 65%. So, keep that in mind. The second point, which people completely forget, is India has a very, very low savings rate, and has a very and so in order to do the capex that we do, we require foreign capital. Unfortunately, the current government, as well as all the people who come on CNBC, keep saying, oh, screw these foreigners. They don't realize that if we don't have foreign capital, we will not be able to do our capex, and hence we will not be able to generate the kind of GDP growth, because sustainable GDP growth requires sustainable investment in capex and something called gross fixed capital formation. So, so the thing is, what you're seeing out here is that I don't know how many of you have observed in the last 2 weeks, the uh, deposits in a banking system have fallen by 74,000 crores in 2 weeks, huh? And at the same time, your credit growth has been about 25,000 crores. So there's a gap of 100,000 crores. Now, if you try and look at the system, money is going into the stock market. It is replacing foreign investors. It is replacing corporates or private equity who are raising capital. A lot of the new IPOs that are coming in are, offers for sale, which means the money is going out of the system, okay, or paying down debt. So as a result of which, what's happening is money is coming out of the banking system, and in effect reducing the capital being deployed. So at some point time, if you believe that credit growth continues to remain strong, and you don't have deposit growth, and then you'll have your deposit rates going up, and it's already up. It's banks are offering 8% now. Believe it will eventually go to 9%. At 9%, how many asset allocators, even forget about abroad, even in India, how many people are going to stick around with equity if you're going to get 9% on your fixed deposit, right? So think about two things: your deposit rates going up, so money from domestically will start reallocating away from equity. And bear in mind, the mutual fund inflow that you talked about this month was only 3,000 crores, despite the fact that SIP was 13,000 crores. People are effectively running out of money. So don't look at the SIP number. Okay, if people are investing in real estate, that is going out of somewhere, right? The money is not infinite, right? So if money is going to real estate, money is being taken out by foreigners abroad, then money in the system is reducing, right? If the RBI decides to print more money, then the rupee depreciates, right? It's so the point I'm making is that once the asset allocation decision happens, which I believe will start happening in January of this year and June most likely of next year, 2023, because that's when people will have a better idea of globally long-term interest rates. Okay, then at that point of time, if asset allocators reduce their equity exposure, in steps by say 5% every year or 10% every year, then in that case there will not be any foreign money coming to India. Period. I'll end there.
So I think thank you very much for a fair insight, Rohit bhai, and fact. Uh, so in this light, when such a big funds keeping 25-30% of asset allocation to equity, what do you guys suggest to the retailers? Should they sell it off all their profits and sit on the cash, wait for an right correction to happen, an X level or Y level, or what do you say? Because one quote there said that don't time the market. So what is your suggestions or what is your guidance to the retailers?
I think it's stupid to say not to time the market, because if somebody bought, for instance, Microsoft shares or Amazon shares back in 2000, and he never made money for between 7 to 10 years. Okay, so you have to there is something called valuation comfort. Okay, so that is one very important thing. And the second thing is, think about it. If SIPs are coming in at 13,000 crores, but at the same time the net inflow is only 3,000 crores, that means those HNIs who've got lump sum money into the market are taking out money. Obviously, there's a gap of 10,000 crores, right?
Absolutely.
Yeah. So the smarter HNIs are taking money out of the market. The stupid retail guys who are putting in 2,500 every month. That's the average size of your SIP. It's 2,500. Those guys are saying, okay, I will keep, because they keep hearing, guys like Sachin Tendulkar and Dhoni suddenly deciding to come and say, come to the market, right? So that's the problem. But the point is that HNIs are removing money out of the market.
Yes. So should some part of the portfolio to be sold off and sit on the cash?
No, we are not giving advice over here.
No, just not an advice to an specific, but how does the retail should behave in that case?
Anand, I and Rajat have already shared in the beginning our position in terms of how we are positioned. We can share what we are done.
Yes, but what?
So that let's leave it over there. That sort of says everything.
Perfect.
Yeah. Next, TTA with. I'm not sure if you can share the name also, TTA, because it's not a name.
Yeah, it's actually my company's name. It's Tech. Okay. Yeah. So I'm a big fan of you and Anant Acharya because of your wild moves and like bindas type. give your views, irrespective of what others will feel. I would like to ask you one question, both of you. Have you seen Nifty in dollar terms? Because in dollar terms, it tends to lag 6 months, and it haven't yet surpassed the older high.
So analytically, I look at it sometimes, but it's not tradable, which is why I do analysis. Between 2010 and 2020, the dollar sense did not make a new high at all. But eventually, I think it did. I think late in at some point of time. Then again, it failed because of COVID, and now again it has gotten just back to the same level. So yeah, I don't know. I found more utility in looking at maybe the index relative to gold or index relative to inflation. I haven't found so much utility in studying it relative to the currency.
Okay.
I just wanted to make a point here. I wanted to make a point here. Whoever it was, you take my name and Rohit's and say we give some wild views. Truly, they are not really so wild. They're backed by a method, and there is a method to that madness. So it's just not wild. Please don't say that.
Rohit, have you seen the rupee?
Right now? Right now, you're saying?
Yeah, it's. I mean, it. Obviously, in the last half an hour, it touched almost 83, but now it's at 82.87.
Okay, no, I didn't see it, but I've found. I mean, earlier it used to be fairly liquid. I've seen some erratic moves in the night. I don't know if all these CFD markets are really not. But yeah, it does. It's at least gone past the last 3 days high. I can.
Fact finder, the width of the base is equal to the height of the move. It is going to touch 87. So 80 to 83, 80 to 83, but don't get, don't look anything. Without touching 87, it is very unlikely to hit down.
No, on that, if you guys allow me 1 minute, is that okay, Rohit? So I just want to share some points on the rupee. I think one thing that a lot of, and since there's a fairly large crowd out here, let me just tell you one thing, that today there is something called the forward premium. That forward premium typically is the difference between the inflation rates of what you experience in the US and in India. Don't look at the the reported inflation numbers in India as well as US. Rather, you should look at, for instance, actual inflation on the ground, because as well as, more importantly, how much RBI is expanding their balance sheet. Because that effectively provides, if they expand the balance sheet much more, your or the M3 grows faster, then your rupee depreciates more. And it's interesting that while most other currencies like the euro, the Japanese yen, less so, but euro, the GBP, the Vietnamese dong, the ringgit from Malaysia, the Canadian dollar, all of the Singapore dollar, all these guys have mean reverted recently, right? In this entire rally by the when the US dollars weakened, the only exception was the Indian rupee. And the reason is that what the RBI did is that they did two things. What they told you was that they reduced their reserves, forex reserves, only by about 80-90 billion dollars. What they didn't tell you was that they reduced their forwards by 60 billion dollars almost. So everybody focused on that one number, 80-90 billion dollars, but nobody focused on 80-90 plus 55-60, which is $130 billion intervention in the market in the first 7 months of this year, right? And because of that, the rupee premium has fallen to 1.6%. If I was an importer today and I had to import products for the next 12 months, what I would do is I would lock in this because it is cheap. Normally, I would have to pay 4 to 5% or 6%, Instead of that, I'm just paying 1.5% to forward provide me forward cover, and I would enter import contracts with several of my associates so as to get stuff to India at a cheap rate. That's what the RBI is doing effectively. In order to show that the rupee is strong, it is incentivizing importers to import more, which is will backfire on India. The second problem is that with such a low forward premium, Indian rupee, uh, instead of the dollar or some other currency being the carry trade currencies where they use that currency, borrow that currency, and invest in India, Indian rupee turns out to be the carry trade currency, which means they would borrow Indian rupees and invest in other markets. So again, the demand for dollars increases. So again, we are creating further problems. And the worst part is you have $280 billion of liabilities, foreign borrowings that have come up for repayment this, starting July of this year. Now, the problem is that the cost of borrowing in dollars or refinancing in dollars is greater than the cost of refinancing domestically. So, no corporate will say that I will borrow at dollars expensively. They will say that, boss, I will borrow domestically. So, demand for domestic credit is going up, but they have to still pay those dollars because they're not refinancing it. So again, demand for dollars, which is the reason why a currency is behaving very irrationally. When people say, crude oil is crashed, rupee should appreciate. It's not. So I just want to finish that.
You're saying there's a large carry trade happening in the Indian currency. That's one.
Yeah, it's a mix of three things, right? One is you're encouraging importers to sign, 1 year contracts to import stuff because it's cheaper to do that. Secondly, you're providing a carry trade. And thirdly, you're disincentivizing exporters from bringing in the currency faster. And fourthly, you have the cost of funding domestically is think about it. If your emerging market bond yields are at 8%, okay, uh, or an investment grade bonds are at 6% dollars, what is your and your your Fed rate is at 4.5. What is your borrowing rate for a for Indian company abroad? It'll be quite high, right? It'll be about 7-8% dollar terms. You're getting 8% Indian domestically for India. So why would I take the risk of borrowing abroad?
Hmm.
Can I ask a question, Rohit?
Yeah.
Yeah, my question is it's nothing directly related to stocks. The one problem that we are all facing, that is, I don't know, at least I have faced, that is, if you try to subscribe to some foreign journals and all that, your credit card, you can't use it. Is it really just that data is being stored elsewhere and that is becoming a big problem for RBI? Or it is an indirect discouraging spending in dollars?
I don't sound like a discouragement at this point of time, because I think the ruling they made is really related to storage and how you save a card, especially in recurring payments, because most international subscriptions are recurring. And they said that recurring payments means you're storing the data. And if you're storing the data, then you need to take approval from the customer before you store it. Whereas earlier they were simply taking the data and storing it without taking your particular approval. That is what they say. So you just have to reapprove it, and after that it is working. So I don't think it's more than that. I don't think it's a discouragement.
No, I think there's another security angle there, because in internationally you can just swipe your card, and if someone knows your CVV, any amount of transaction can go through. So I think a lot of fraudsters have been doing that. They get the card number and they get the CVV, then it's very easy to swipe it anywhere on odd locations and then not get caught. So I think that's also one problem. And yes, OTP has started to come on all international transactions. So I think that's very good as a security feature.
Yeah.
Rajat, you're right, Rajat. I think they have put certain limits on how much you can spend on your credit card. Similarly, they have put limits on, and the reason why they are doing this is because what used to happen, you have that $250,000 limit, right, every year. And for them, it's hard to put a cap on that when you have a credit card, right? Because if I were to transfer money earlier, for instance, if I had to transfer money, abroad, I didn't have to pay a TDS. Today, I think this rule started about maybe a couple of years ago, where if I transfer money abroad now, then I have to pay a 5 or 6% TDS, right? Which I can then claim against my income tax. Um, so how do you implement that through credit card, right? Because
Fact finder, if you are earning in forex, there is no limit on what you can spend.
no, we are talking
Okay?
about individual. We're talking about
Individual. If you are earning in forex, if a company is earning forex for India, there is no limit to the amount of expenditure it can make in US dollars. That 250,000 is individual personal expenditure that is allowed.
no. That's what we are talking about: individual credit cards and individual persons, Anant. I'm not talking about.
Yeah, for example, I myself, I do get a lot of forex revenue. There is no limit on what I can spend on my credit card. I can spend as much as I want. There's no law which keeps me, because I can always get away by saying that this is expenses towards future revenue. So that there is no limitation on that. It is only when you are not generating forex the limitations start applying. I go through this every year, so I know it very well.
Okay. Let's move back to markets. Mahadev, you have a question?
Yeah, hi sir, good evening. I just joined. I'm not sure whether this has been already discussed. रोहित सर, आपका ओपिनियन जानना चाहता था मैं कि PSU बैंक का जो रैली हुआ है अब तक, what is your opinion on that? कि if you hold the PSU bank, will you hold further or you book profits?
So I had a bullish view on PSU banks in March. After that, I've sort of the only update I've given in the last 2 months is that the volume pattern shows peak volumes, which means this is like a sporadic one-way rally which is happening on volumes which are the highest in like years, which is usually a sign that some kind of a peak is coming now, whether that's a short term, medium term, whatever. But when you make highs of this time on peak volume, it means that those highs, once they are established, of course, the rally has gone on over the last week or 10 days since I've been saying this. But once it is established, then those highs don't get taken out for a long period of time. Whether that long period is several months or it's several years, that depends on the overall view on things. I'll not specifically recommend whether you should buy, sell, or what you should do, because we don't want to make any recommendation. But my sense is that the PSU bank rally is overdone. So I think you'd be at the end of something for several weeks at least, or months, nothing less than that.
Yeah, thank you, sir. And one more general doubt I have is, sir, when let's say Nifty falls to 15,000, up to 15,000, because Nifty is made of those big companies like Reliance or HDFC, right? We have, let's say, 3,000 scripts. Sir, I'm a newcomer, so my question may be dumb. Where do we see the correction? I mean, does the majorly Nifty को जो contribute करते हैं latent talks, will they correct, or it will impact across all the stocks? Sir, what is your opinion?
My sense is it will be more broad based. Yeah, I have answered this one, but it will be more broad based is my short answer.
Yeah, thank you, sir. Thanks.
Yeah, Kushal.
Yes, Rohit.
Hi, go on.
Yeah, so what I wanted to ask about is that the recession part we are discussing mostly. So is it like that when the official recession is announced, the half of the damage will be done? And then actually after 2-3 months, we can see the recovery starting, like in the economic front, not in the stock market front. Mostly that will definitely follow the economic front recovery. But yeah, that is what my question was, because currently we are seeing that mostly the economic parameters are not very good on the inflation part, on the recession, the new jobs being added part in US and also in India. And whatever the contracts that we are seeing, like Mostly I work in IT sector. So what I'm seeing right now is nobody is able to see more than 3 or 6 months forward. Like whatever contracts we are getting, they are mostly for not more than 6 months. They are saying right now because they don't know if they will be able to borrow at the same rates that they are going about borrowing right now.
Okay. So this is what history, I'll tell you what history shows. History shows that at the point that you recognize a recession, okay, and this is from a US perspective, which is also what we are calling as the pivot, is basically when the central banks recognize the recession, they start cutting rates. The markets tend to tank further simply because that's the point at which they realize that, oh, earnings are going to fall a lot more from here. And that then tends to get discounted in the next, couple of months. But in terms of an actual economic revival, it takes up to 300 to 400 basis points of rate cuts before we've actually seen the economy start to revive. And this is what happened in 2000 and 2008. It took up to, so the average, I think somebody also did a study in Global Macro on 37 years of data, seeing what happens. They said within 1 year it's 300 basis points, and over 2 years it's 450 basis points of average rate cuts before you got a revival in the economy. So those are the estimates.
Okay, got it. Yeah, so we have to see like 300 to 400 basis point cuts from Fed to actually say that we are out of recession and inflation is okay now. Yeah. Thank you.
Mayur Malpani.
Yes, sir. Good evening, all of you. Hello.
Yeah, go
Yes,
on.
sir. Sir, the whole Twitter space was going very great, sir, and I would like to thank all the very good speakers around. Sir, my question is only about what kind of currency fluctuations do you think? Like, if the 2000 notes are not there in the rotation, then will it impact that the gold and real estate markets will be stable in India, not falling too much like the international markets?
You added another angle. Currency will not be in circulation. 2000 rupee note तो अभी भी circulation में है ही नहीं, as far as I know. दिखता कहाँ है?
I would like to say this, that 2000 rupee notes are, although it is not officially announced, I got it from my some banker friends that it is no more getting printed. In fact, if you transact in 2000 rupee notes and if that reach to the bank and finally to RBI, that goes out of circulation. So 2000 rupee notes are a thing of the past unless you have it in at your disposal and you come out with it. That is a different story. Otherwise, 2000 rupee notes are not in circulation. Mostly, you don't get to see them anymore.
Rajat, everybody, see, there's a difference between not printing fresh 2000 rupee notes and 2000 rupee notes in circulation. When you talk about circulation,
No, I stand corrected. I actually wanted to say that yes, it is still in circulation, but fresh notes are not being minted.
Yeah. So to answer your question,
No, sir. I would like to add one point. It is not in circulation. By circulation, it means it goes from bank and comes to bank. So, but if when it's coming to bank, it's not going back from bank.
No, Mayur. That is because you're talking about from your point of view, right? Let's look at data, right? What is RBI thing which it reported on the amount of 2000 rupee notes printed and in circulation? Just because you don't get it and the bank keeps it doesn't mean it's not in circulation, right? It could have been given by a bank to a corporate directly and who would once again deposit in the bank, but that still is circulation, right? If it is printed and not destroyed, it is in circulation. That is the definition of circulation. May not come to small people like you and me, but it will be there with somebody else who's big. Okay.
But why would that happen? Like, matlab, when it is circulated, it is not of the currency value. It is currency. It is the complete capital which is getting circulated, and never corporates never go for cash withdrawals or something like that.
Yeah, I agree with you, Mayur. You should probably tell that to all the real estate people who pay 50% and 60% in cash in Delhi. Okay. I'm being sarcastic, but the fact of the matter is, even today in real estate, I have access to 2000 rupee notes. Okay. So it's not like you don't get it.
Yeah, so the ones which are hoarded are there in the circulation. The ones which are going to bank are not coming back from bank,
See, again,
and there is no new printing.
you have proof of that? I
Yes, I do have. I do have bank tellers as my friends who say the same thing to me.
boss, again, that is all it's like saying that India is booming because there are no hotel rooms, right? But there are only 130,000 hotel rooms in our country for a population of 1.4 billion. So don't go on small little data points that my friends tell me or my uncle tells me you can't get a SUV. So maybe there is no cars available, because SUVs only make, the top end SUVs only make up 7% of the car sales. And only 2% of Indians buy a car, new car. So don't go on, data that is based on my uncle told me this, or my friend told me this, or my cousin told me this. Never go on that. You have to go based on
This is
actual
a very
data.
gray area. Let's just leave this thing alone. It's no point continuing on it. Bharat Gupta, you have a question.
Yeah, hi Rohit, thanks. Question is to you. One, I know you have mentioned three different levels that we can hit in the next downturn, which you say will happen in 2023. What probability would you assign to each one of them? So I think you've said something like 15,200, 12,000, and 7.5, right? So what probability would you assign to each? And secondly, what is your view on gold for next couple of years? Thanks.
So I know people would like an exacting answer on exactly what you expect, but I don't think I have that answer. The way I look at it is there a risk or is there no risk? Okay, right now I'm not able to assign is it 10% or 20%. I think the risk, if you asked me the same question a year ago, I would have said no, it's just going to be pullback, or the things will just go up because around the world they want more inflation and want to inflate away the debt. But somewhere that narrative changed. Whole FMP theory, which they were hoping to carry out, allow inflation to persist. Somewhere it appears to have changed. No, if it appears to have changed, it sort of slowly changed the situation. And I think the main reason why, let me just say, the reason why I opened up to the idea of, you know, the worst case scenario, which is, can it go to 7,000? That discussion is really based on, can bond yields go to 9.5%? I think that was something I was anticipating in yields in 2018. It's called the last spike before yields can really go down, and that last spike did not happen then. And then I thought maybe I was over expecting it, and now you're actually seeing it happen. And if you're seeing it happen, then you've opened up the worst case scenario for equity. And therefore, I don't know what probability to put on each of those numbers. But if there is a risk, I might as well stay protected from it and figure it out along the way. Because by the time you get there, you'll figure it out along the way rather than today when we are still at 18,000. So when you're halfway through that course, you might actually then right now.
The only thing is, Rohit, and I know you are always diplomatic. I mean, I'm a subscriber to India Charts.
No, I'm not.
नहीं, the reason is, see, अगर 15,000 पे जा रहा है तो boss, it's only like 20%. It's okay. I'm a I look at things from a longer term perspective. So ठीक है, 20% drop down is okay. No, some shares will go 30%, etc. It's all fine. I mean, so there is.
So there must be a reason.
But it's only thing is, if you're looking at, if you're going to say 12,000 has got a higher probability than 15, then I might just think a bit differently. That's all.
Yeah, so there's a reason why I'm talking about 100% cash.
Okay. And that trigger for 9.5% bond yield is if it's going to go above 7.5, right? I think that's what you said in your report.
That's like a major confirmation. We can end up being, हो सकता है कि नहीं हो सकता. So I said cut off. You fight. There's no fight after that.
Okay. Just what? And the other one was around gold. Do you think with whatever else is going on around currencies and geopolitics and central banks buying gold, You think there is a potential to invest in gold? I know you've said in short term it can hit 15,100 or 1510 or something, but you think from a long term?
So earlier we discussed it in terms of currency that it can go up in rupee terms, but not necessarily that much in dollar terms. So I think there may be a difference based on the currency, because in dollar terms it may be impacted by the rising dollar index. But if the rupee falls very sharply, gold in rupee terms might do well, which is what is happening right now. Is that gold in individual currency terms is doing well around the world, but not necessary in dollar terms, and so that is the way to think about it.
But I think आप उसमें तो आप so I think even on rupee you are saying it can go to in the 90s, right? But general
Yes,
consensus
87,
88 is the general consensus.
at least that much.
You think it can go above 90?
I'm not ruling. Eventually it will, because the fifth is just the third week going to 87.
Okay. चलिए ठीक है. Thank you so much, Rohit. Thank you.
Yeah. CA Kamal.
Hello, Rohit.
Hi.
Hi. Rajitda, how are you?
Good. Tell me.
Actually, I had a question for the Harsh as he's left the space. So can I shoot the question to you?
Surely.
Actually, he was emphasizing a lot on the breakouts of the metal sector and the auto sector. दो तीन साल का breakout हुआ है. So there will be a 4-5 years breakout. But why is ignoring the breakout in the DXY and also the breakout in the interest rate? As there's a 7-8 year breakout in the DXY, so it must continue for the next 4-5 years. And when there's a breakout in the interest rate, it also should break out for the next 3-4 years. But he's emphasizing only on the metals and the autos and the capital goods, but not on these.
Yeah. So that is essentially what I also told him in the end, that the dollar is broken out, and so that is the reason to keep the other risks open in terms of downside. So there are breakouts in those individual commodities and the sectors. And what I also highlighted is that this is very, very similar to what happened between 1990 and 2000, which is during that period, after a long consolidation, many of the core economic sectors started to break out on what is usually called value buying, the first wave of buying. But because of Y2K, they all went down and retraced 80-90% of those gains again, and then the actual bull market started. So we are seeing breakouts this time. We are simultaneously seeing an unwind in the US, which is why I find this similar to what happened back then, that you broke out and then you had a setback and then you actually started something afresh. So that's sort of my remark on that.
Okay. Can I ask something out of context and some behavioral question, Rohit?
Yeah.
I was going through one of the space in the last 2-3 days when somebody asked you, or like a convict asked you, when the person is of half of your knowledge, half of your experience, and half of the technical knowledge you have got, and when they ask you like a convict ki aap bolo 87 hoga, aap bolo aapne kaise bola 87 hoga, how do you manage such cool approach? This is a behavioral question. I have a lot of problem when somebody asks a question with half of my knowledge or half of my educational qualification. Then I get irritated. I cannot, and I see always you are so cool. I don't know how you maintain that. Can you please share the secret of that?
I don't know. Bhagwan ने ऐसा बनाया है. So this happens when Chavan, who's in my team, is there and used to attend these spaces. You notice he doesn't attend them anymore because he completely loses it when somebody does like that. He says, "Band karo, usko room se nikalo." I said, "Cool, hang on."
So he's there right now.
People are only speaking, huh?
So Chavan is there right now in the space.
And Rajatda is here. Rajatda is my first technical guru.
I maintain my cool. Actually, Chavan can give you a better answer. I have no idea, but I think it's human. Chavan, people haven't been hearing you on the weekend with India chat, so I think you have to stay.
Okay. No. I've become very cool, Rohit. I'm very cool. all I do is I listen and I leave it out from the other ear.
My answer to that is I never take most criticism as criticism. People may think it is that way. So when people are trolling, also people say, "How are you answering the trolls? Why don't you just delete or block him?" And I'm like, I don't read the critical part of it. I read that he's asking a question. Okay, and maybe there is an answer. So I try to think what could be the right answer to that. Why is he facing this problem? Why can't he understand what I'm trying to say? So I try to think of how do I explain to someone. Now it's only now if he's a real troll, he will not accept even that answer, and then we realize that he's worth blocking. But otherwise, if someone really accepts that, yeah, okay, he understands what I'm trying to say, then it at least ends well. So, but there are various reasons why people don't. I mean, I think we've seen enough of behavior in people. I think so many years of seeing people. I mean, I have worked in broking for so many years, so sales people are always got a contra view against you. If the market is going up, you're supposed to always be bullish. Give a view only for 200 points. These are the kind of things I've faced over and over again. So why should I then? Why did I do all this science? I mean, I want a space where I say what I want to say and do what I want to do. Then I take it from that angle. Why should I get into the you know uh, why should I make the science appear small? Maybe people don't understand the science. So we take it from an educational angle, and then I think approach then how we address people.
No, I've seen so much arrogance. There's a guy a couple of 1 hour back in the space. He was using that 4 letter word, the Fed. I don't follow the Fed. I follow the trend, something like that. I find very disappointing with with so much arrogance with the knowledge. If they go right, and when they go wrong, they keep on hiding.
Yeah.
May I say one thing here?
रजत दा कैसे हैं आप बताइए?
मैं तो अच्छा हूँ. मैं आपको ये बताना चाहता हूँ कि जब ये फेड को गाली देना, अपने देश सबसे आगे निकल जाएगा. These are what George Soros calls a super bubble in formation in a particular country. They become, over empowered. So you with age, with experience, you will take them in their stride, in your stride, and ignore sort of things. The same thing with me. Initially, I used to get very pissed off, but I never made any bad comments. But the only thing is that these days, कितना भी गाली दे दो, हमको उतना कोई फर्क नहीं पड़ेगा. गाली देना है, दो ना भाई, क्या प्रॉब्लम है? ट्विटर फ्री है ना. One last thing.
No, Rajata.
One last thing, lest I forget, because it's a SEBI mandate, I must disclose that I personally hold Infosys in my portfolio, which of course I might take a decision to sell, but this is the mandatory disclosure, because if I have talked about a stock in which I have positions, before the show ends, before the space ends, I got to disclose. Thank you for giving me an opportunity, but I'm there. I'm not going away. I'm just making the distinction.
Sure.
See, for readers of sentiment, I think arrogance is the peak of greed. So this kind of arrogance and defiance is somewhere the peak of greed. The only thing is that these kind of phases can last weeks and months and sometimes years, and that is what we are witnessing right now. So the arrogance is also at its peak and it's at its highest. I think I did not see this kind of arrogance in even 2008 top or probably the COVID top. So till I think 2018, 19, 20, all those tops, this kind of arrogance was still not there, which has somehow come into this move. So I think peak arrogance is peak greed, and we all know that the market shifts between greed and fear. So you reaching one extreme is definitely that case. But yeah, as I said, they take some time, so it's always difficult to put an handle on that. But as we've been discussing, that this is definitely overstretched.
So this has already gone on for 2 hours and 50 minutes almost. I think I'll close it at 3 hours. Another 11 minutes, I'll take as many questions I can, and then we will end this session. It's longer than usual. Manish, you have a
So I
question?
will also put my disclaimer. I think we're doing this space more for the educational purpose. So everybody should be taking the comments in that context, and you guys have to always check with your investment advisor. And this is definitely an educational space for me.
Yeah. Manish.
Thank you, Rohitji, and I really follow you, and you have a fantastic reading. I can just vouch for it. The only thing is that means I have been very bullish on pharma,
and I have been following this stock Biocon based on my reading of charts that there should be a reversal in the charts. But somehow this has not happened, and it has been continuously. Though I have not taken position because I take long-term positions, so I really wait for the breakouts and all those things. But I see that pharma is somehow not taking up. Means it's slowly dwindling down each and every stock except a few top guns. So how do you take it? Thank you.
So my thought sometime back, and I mentioned it in some of the weekly sessions, that if I had to, find defense, where would I in this kind of market? For some time, I thought it was the defense sector. Fine, it did well, and then I thought it was pharma. Pharma somehow has been very, very lethargic. Apart from the rally that we saw in the initial part of COVID, the sector has actually not performed meaningfully. And while I've been waiting for a low point in some of these individual stocks, they just don't seem to play out. So even while thinking, okay, the last part, like before going 100%, I thought that okay, वो 20-30% जो रखा हूँ चलो pharma में ही रखता हूँ. But it's not holding out, So that is where I'm giving up, because my memory from say 2008 also, or 2000 rather, is that even though these sectors are, we call them defensive, they did go down quite a lot in the unwinding of Y2K, and so there are losses to be had. Then we are simply playing a relative game कि चलो ये कम गिरेगा इसलिए ले लो. So I don't know. I've just backed off, generally saying that I guess something is not right. I mean, so we are not getting something right in why pharma is not working. I have no idea why it's not working. I just know that it's not working. So might as well avoid it, even though it appears like the logical defense in this market, but it's not working.
Thank you, Rohit sir.
Gunjan. Okay, Gunjan is not speaking. Mahendra Gupta.
Yeah, good evening, Rohit.
Good evening.
I got some couple of short questions. You can.
Yeah.
What will be which will lead the fall? Is it Bank Nifty or the Nifty because of the bond yield increase?
My sense is it will be pretty much broad based, because rising yields affect almost all sectors that are interest rate sensitive, whether it's autos, real estate, and so on, metals. Generally affects the economy. So my sense is whatever is going to happen next is going to be very, very broad based, not going to be one particular sector only.
Okay, and what will be the effect of on real estate because of the increase of interest?
Well, one impact is that your demand takes a hit. I think so. One of my friends has been telling me again and again that DLF was on television saying that if rates go to 9%, demand will completely dry up. I haven't seen the interview; it's just an information piece. But if that is true, that is sort of the effect that you would expect.
Will it lead the fall of the equity, or it will be lagging?
See, lead lag is when I say broad based, which means that you expect all sectors to underperform when you get liquidity tightening. Now, which one will fall more, which one will fall less, is I don't know if I can really.
The last question: What is your opinion when the Indian market will bottom out? Will it be first in the globe, or the US will bottom out first?
Again, see, I can't say this in advance. It's always based on structure.
It's always a probability.
Yeah.
You can give a
No,
rough
not just the
estimate.
probability. So we are relative wave analysts, right? So we look at the structure, which is basically a behavioral fractal. Now, if I go into letters and numbers, I will say when I say Z end, which means you'll see on my charts W X Y X Z, and the point I've marked Z is when it will end. Now, will Z in India end before the US? Sometimes it does, sometimes it doesn't. 2009, both India and US bottomed at the same time. But 2001, India bottomed before the US. Now, which one is it going to be this time? So we'll have to watch the structure and sentiment and make that call. I don't think we can make it in advance. We know what happened the last two times. I mean, US bottomed late because of 9/11. 9/11 happened, India bottomed out. US still rallied and made a lower low in 2002. India did not make a lower low. So, will you see a similar situation, which is event based, that causes that deviation? It's really hard call right now.
Okay, last question. Rohit, EW International is saying that this correction will go up to 18,100. What is your opinion?
I mean, 18,100 is just the short term move. I think not even 18,100, it will go to maybe 17,800 or so. But that's just the short term move. By the time we get there, we're going to get medium term moves and further changes for the downside. So, see, EWI's problem is what? They were bearish on everything, which means everything will fall together. Then they ended up, because I think Proctor got old, he ended up hiring many analysts, and he has analysts for every part of the world. Now his Asia analyst is bullish and all his other analysts are bearish. But if you hear how bearish he is on US, you cannot imagine that Asia can go up in that.
They are very bearish on the US, but in the Indian, particularly Asia, they were
it doesn't work now. It doesn't match up. So that is where I disagree with them.
Okay. Yeah. Thank you, Rohit.
Gautam?
Yeah, hi Rohit sir, good evening.
Good evening.
Yes, sir. My question was, as you were saying that this should be a broad-based fall. My question was, Nifty compared to mid and small caps. Say the small cap are still 20% down off their peak. So, do you think like means whenever the sell-off will come, whether the say the downfall would be similar, or again as usual the mid and small cap will be pummeled more than the large cap?
Well, it's always the broad market, that is mid and small caps, always tend to fall more than the large caps most of the time. But say 2018 to 2020, mid and small caps fell so much in advance that when the pandemic crash happened, on a relative basis, if you actually look at the Nifty to mid cap ratio, it did not fall during that crash because both fell in the same percentage terms. But that doesn't mean they didn't fall, both fell.
Right. So that was actually means the ratio was my question, because again this time what
but this time that's not the case. The ratio is not falling. I mean, not falling. That is, the mid caps have been holding up at a higher level. They have not been crashing like they did in 2018 to 20. So, which is why my sense is that they will decline a lot more than the Nifty. Even if you see the ratio, I think if you've read my long short report, I have given the mid cap Nifty ratio. You'll find that the ratio has retraced a large part of the fall it saw in 2020. So, but not made a new high. And it's stuck in a range. So, it has a long way down to go. Whenever the downfall comes, the ratio will probably fall, which means the mid caps fall more than the large caps.
Okay, but I'll tell you why. Means I was specifically interested in this question because I've seen the market right now. Many experts or even the mutual fund houses are coming up with mid and small cap NFOs. So basically, they would always time it like that. That whenever they will find that there is a chance of lower the fall to be lower and gain to be more, then only they'll come up with such kind of NFOs. So the means and many analysts are also saying that mid for 2023 mid and small caps would actually outperform. So I thought that I'll ask this question. Thanks a lot anyways.
Yeah, thank you. Siddharth? Siddharth Kamal. Okay. Bhuvnesh Kumar.
Hey, hi Rohit. Congratulations on a great session. Less eventful and more informative. One thought that I wanted to have with and discuss is, as an asset, basically portfolios are all about asset allocation. And when you say that you're sitting in cash completely and in general, for the next year, so as to say, which would be the asset class that probably you would want to hide in till the time you get back into equities, and that can be a moving number. I don't know when will that happen, as I said.
So I would start with dollars because the dollar is still bullish, and in Indian context, dollar means USD INR. Okay. Eventually, maybe gold, but then, like I mentioned earlier in the discussion, gold is nothing but a substitute to a currency hedge. So if you can directly own currency, very good. If you can't, then your indirect way of owning currency is to own gold.
And would you restrict your allocation to fixed income still? I heard the conversation as what you're predicting, but would like...
I don't think it's time yet to go into debt.
Sure. So probably from a retail orientation, the only way to do that would be to sit in gold, right? Because most retailers would not, as a matter of fact, be able to take direct exposure to dollars, so as to say.
That's right. That's right.
Thanks.
Manish.
Sir, good evening.
Good evening, Manish. How are you?
Sir, I am good. Sir, after your long short report, I mean, things are very clear how to go ahead with the market.
Yep.
Sir, my concern is that in between rising bond yields and the depreciation of INR, which is more concern for you? And how do you look the base metal asset class in the coming year, 2023?
So from the impact to equity, I think bond yields will play a bigger role than currency because interest rates drive valuations. So that is why I'm looking at yields. So that sort of answers that. Otherwise, both are important macro events, and like I mentioned, the yields will be driven partly by the currency move, but the yields will be the killer for equity. So that's why that is going to be important. Oh, what was the other part?
So in the coming year, 2023.
Saying about base metals.
Yes.
So see, as long as the dollar is in a bullish trend, I don't think your commodity rally will take off again. You had one rally, and if you saw the wave count, we have done A, we have done B. We are sort of making a B triangle in the commodity index. So there is a big wave C down pending. Only after that would I look at the metals and base metals and all again.
Okay, thank you.
So we're closer to 10. I'm not taking in any more speaker requests. We are done with this session. Chavan, you want to add any final points? And Jay, I'm going to allow both of you to. Chavan, you want to add something?
Nothing much, Rohit, from my end. All I can say is now things are becoming more and more clear on the market, so let's hope for the best.
Jay, anything I missed? We've had a long session. I'm leaving you to put the last word in.
No, sir. I think, I mean, these are basically those facts only which we mentioned it in the last, spaces as well. I think it was not recorded, so I'll just reiterate that. I don't honestly have much to add to that. The only thing was that, which I had mentioned was that there are always two way to look at it. The rally from the bottom, either it is corrective or impulsive. So far there has been no evidence, as to say that the rise from the bottom was an impulse move. And apart from that, the characteristics as well doesn't really tell you that it was an impulse move because the breadth has been narrow. These are all classic signs of corrective waves. So yes, so I mean there is certainly a lot of risk that is there in the market, and we ideally need to be prepared for that.
Brilliant, Jay. Let me just highlight you stayed on track with this. Helped me a great deal in keeping my mind together. We've been talking today because that's, I think, one of the most important things that we are able to take a fair judgment of things without jumping this way and that way all the time. Usually very difficult, comes with experience and maturity. So great job
No,
done.
sir. It actually comes from burning money. when you when you when you forcefully try to fit in an impulse when it is not an impulse, you end up burning a lot of money. So it is probably that experience that is speaking right now.
No, but it has helped us discuss and come to that conclusion every day. Ki nahi, we are on course. So that's been really great. And so I think that's it. Long session, but I think everything needs to come to a close. Fact Finder's raising his hand again and again. You want to put in some final word, or shall I?
I just say something because I think one of the questions a lot of people ask is how long can stupidity get maintained, right? Let me give you a very good example of another market where if you think India is crazy when it comes to youngsters or people coming new to the market trading, there's a market called Korea. It's even worse than India. It's like 10 times worse than India. Okay, there you have kids who are 13 and 14-year-olds trading the market. Almost everybody was trading the market in 2020, right? And just for perspective, during the year 2020, foreigners sold $30 billion in Korea. Logically, and one peculiar thing about Korea is that Korea doesn't have much active fund managers. The entire active fund manager industry has disappeared. It has come in through ETFs. So Korea is a very big ETF economy. And what I wanted to say is that during the year 2020, when foreigners sold 30 billion, the ideal thing was that you would think that the market would correct, but the domestic retail investors kept buying, and the market actually did well. And then here we are today, where the market is crapped out, right? So eventually, when there's a level to which domestic investors can keep buying, and at some point of time, when they run short of liquidity, then things can just slowly correct. So just look at where the Korean market was in 2020 towards the end, and where it is today. And that's I wanted to share that.
Okay, Rajat, final word, any final points you want to add?
No, not just, what I would like to say is this, that it would be something like January 2008, although Sarvendra said that it is not that crazy as yet. 2008 was less crazy, but the fall could be something like that, which would shake up this SIP gang. That is what I tend to think. And uh, interest rates are the you check bond deals, and you also check interest rates, because they are the real drivers at the end of the day. And whenever this low interest rates regimes are maintained for more than they are required, far longer than they are required, we see turmoil in all asset markets. But this time, uh, crypto came in because of fiat currencies are not being trusted, not being liked, uh, because of government's intervention and playing with them. So there could be a currency market turmoil. That's why I asked that gold question. Anyway, thank you for inviting me. Thank you for. I would have joined anyway, but you welcomed me to make comments. Say that was very good, and I'm planning to become a subscriber of yours.
Oh, Rajat, thank you so much. Huge respect.
This is brilliant. So thanks, Rajat, Sarvendra, everyone for contributing to this space. Everyone else who's come in, asked questions, and added value. I think this has been one of the best sessions we've done in a while. So thank you so much for being here. 3 hours long, and the replay should be there because it's recorded, so everyone can share it with everyone you know. And thanks a lot. So that's it. Bye.
Thank you.